Hey everyone, Meet Kevin here. Welcome back to another Meet Kevin show or episode of the Meet Kevin show. Today, we are going to talk about suing the Federal Reserve, inflation, hyperinflation. Are we going to see a bond squeeze? What's going to happen in the market going forward? And I thought there's nobody better to talk to than George Gammon. Runs an awesome YouTube channel. He's got editors that are like 10x better than my editors, and I'm my own editor. So his editors are freaking awesome. What's up? Thank you so much, first of all, for coming on here. I'm so excited to talk to you.
Thanks for having me. It's always fun to come on.
Absolutely. So I just got to start right in on this. You're suing the Federal Reserve. Why?
Yeah. Well, back in March of 2020, in my opinion, they really blatantly broke the law when it comes to the Federal Reserve Act. So the Federal Reserve Act is the laws that confine them. And, I'm someone who believes that central planning isn't a good thing. And the more power the central planners have, the more you need those laws to make sure that they are constrained and that we, the general public, are being protected from them. And so I had, what they did back in March 2020, specifically buying corporate debt. And I know they did it through a special purpose vehicle and all these things, but that's you can't do that according to the Federal Reserve Act, and if not, at the very least, the spirit of the Federal Reserve Act. So that always really bothered me. And what bothered me even more is the mainstream media didn't even talk about it. CNBC, wow. Bloomberg, you never heard about the Federal Reserve blatantly going against the Federal Reserve Act. Everyone just kind of turned a blind eye, to sweep it under the rug. It was like, well, it needed to be done, so I guess we can break the rules this time. And when you start having that thought, that's a slippery slope.
Yeah, there was, it's so funny you mentioned slippery slope, because if I recall correctly, the Federal Reserve swooped in and through a bunch of exchange traded bond funds, basically bought up billions of dollars worth of corporate bonds.
Right.
And that included like Verizon and Apple and so on.
And junk debt, not just high grade, not just investment grade, but junk debt as well.
Junk debt, geez. So bought up all this debt. I remember there was talk that this is just basically the precursor to the Fed just buying stocks straight up like they do in Japan. Was that one of your concerns as well, that this would be just the slippery slope of basically the Fed just being the buyer of everything?
Yeah, absolutely. And Janet Yellen has gone on record as saying that could be a tool in the future, that the Fed could just buy stocks outright. And again, they're just completely ignoring the law that protects us from them and constrains them. And you might say, well, George, what's the big deal? Sure, it might be the law, but that was 1913, and shouldn't we move on? And what they're doing right now is necessary, and it's providing liquidity, and it's preventing a huge economic disaster. But what they're not seeing is the unintended consequences. So as a result, now you see that corporate debt is at an all-time high. So let's think this through. We've got we'll call it the cerveza sickness out there. We've got 15, 20 million people, Americans, that are not just unemployed, but underemployed as well. And so you've got an economy that's very, very weak and is being propped up pretty much by stimulus. If you took away the stimulus right now, I mean, I don't think anyone that would disagree that the economy would really be suffering, and you'd potentially go into a deflationary spiral. So then you look at the corporate balance sheet, and the corporations have more debt than they've ever had in their entire history. And so you say, how does that work? How does that happen? And it's because the Fed has come in and they've backstopped the market. So they are a buyer of corporate debt. Well, if there's more demand for corporate debt, what does that do to interest rates? That lowers the interest rates artificially low. Therefore, all of these zombie corporations that quite frankly should have gone bust back in 2020, March, April timeframe. Now they're just loading up on debt, which they can never repay because it's so cheap. They're getting a 3 or 4% interest rate when normally they'd pay let's say a 10%, 12% interest rate. People forget how important interest rates are. They're the price of money, and they're there as some people call it a hurdle rate. that if you've got a risky business, well, then they should be charged a higher interest rate. That's the market doing its job to make sure that they have enough cash flow and excessive cash flow to compensate for the risk of them borrowing the money in the first place. So the Fed has come in and distorted the market completely. They've created not just unintended consequences, but explicit malinvestment and misallocation of resources. And they've done that by, in my opinion, breaking the law and ignoring the Federal Reserve Act. And that was the thing that really got me fired up. And then you combine that with the fact that the media that should hold their feet to the fire just completely ignored it and has allowed them to do this. And I mean, I could go down a laundry list of things the Fed has done over the last 20 years that has made the middle class, the poor and middle class, a lot worse off. I mean, we could start by devaluing the dollar. I'm sure a lot of people watching this video know that since the Fed was created in 1913, the dollar has lost over 97% of its purchasing power. And you say, well, that might not be a big deal because wages have gone up. Yeah, but wages always lag the rate of inflation. And if you really think these things through, what it does is it turns our entire society into speculators, to where you have to gamble, you have to go into the stock market, you have to do these things in order just to maintain the purchasing power of your savings. Where if the Fed wasn't doing this, we'd have strong money, we'd have a almost deflationary money in the standpoint that a free market always wants prices going down because there's entrepreneurs creating things at better prices more efficiently. Well, that's a benefit to the average consumer, you see, but we've lost all of that because the Fed, I mean, they're not even doing it implicitly. They're doing it explicitly now, saying we want the consumer to lose 2% of their purchasing power every single year. And now they're saying that if it goes above 2%, maybe 3%, 4%, 5%, they're just going to quote unquote, let it run hot. Well, what is let it run hot? In other words, they're going to allow the average Joe and Jane to lose 5%, let's call it, of their purchasing power every single year, and they're not going to do anything about it. In fact, they're trying to create this environment. They're not trying to prevent it. And so again, if they're doing it abiding by the law, that's one thing, but they're doing this by blatantly breaking the law, and no one is standing up and saying, hey, the emperor has no clothes. And that's why I felt it was necessary to kind of take action.
Well, I mean, wow, that is incredible. There's a lot to unpackage there. I want to start with one of the most salient things that you just mentioned here is that Joe and Jane lose in an inflationary environment, but basically rich people get richer because it's easier for their debt to get paid off.
That's right. And they have assets.
And they have assets. So why, I mean, generally we get taught, or maybe it's manipulated by a society, that deflation is bad, that the deflationary spiral is bad because people are just going to stop spending. I mean, sure, look, my dollar will go further, but then look, if prices keep falling, I'll just postpone spending and the economy could grind to a halt because nobody's going to be motivated to spend. Isn't that a potential downside of deflation?
It is. You've got to compartmentalize deflation. So there's one type of deflation that decreases demand, and that happens in a society that's over leveraged, right? But if you don't have that, then let's go back to the late 1800s in the United States. And most people I've never really done the research on this, but if you look at the prices in the United States from 1800 to 1900, so 100 years, prices actually went down by 50%. So I've done some research on the late 1800s specifically. And during that time frame, you had deflation of about 2 or 3% per year. But
what
you had nominal wages go up.
Was that like clothing? I mean, we had the Industrial Revolution. We had a lot of technology. Was it technology, or was it just lack of Fed?
It was all things combined. Back then we had, prior to the Civil War, we had free banking. So that doesn't mean that your checking account is free. That means that it's free of any government intervention or a central bank. So back then, banks would literally print their own currency in some areas. And so you had this a check and balance there, where there were no bailouts. So if the bank did something bad, they would just lose everything. So they are incentivized to make prudent loans. Well, if you're making prudent loans, you're lending not for consumption, but you're lending for production, to the creation of more goods and services. And that's deflationary. But when you get that type of deflation, Kevin, you have wages actually going up in nominal terms, and per capita GDP actually went up in nominal terms, while the price of the stuff the average Joe and Jane buys daily goes down. There's a thought experiment that I use in one of my videos that I think illustrates this well. I don't have the specific numbers right off the top of my head, but your audience will understand the concept. So let's just say you go back to that time frame and someone was working at McDonald's at today's dollars. So let's say they're making $1,500 a month and their expenses are $1,500 a month. So they have absolutely no money. They're at a break even. They can't save. They can't invest. We've heard the story 1,000 times. Well, if they stayed in the exact same job for the next 20 years at a 2 to 3% deflation, while nominal wages went up by, let's say, 1%, which is very consistent with the numbers we saw in the late 1800s, what you'd have is that person at the end of 20 years, their wages would have gone from $1,500 to roughly $1,800 per month. You say, well, that's terrible. I mean, they've been working for 20 years. They only got a $300 a month raise. But what you're forgetting, their expenses went from $1,500 a month down to $800 a month.
Wow.
So now they're sticking in an additional $1,000 a month in their pocket, where before it was a complete break even. And I'd also like to point out that the value, the purchasing power of that $1,000 is more than it was 20 years ago when they started in the first place. So we talk about, well, how can the Fed eradicate poverty, or what can we do to improve the wealth gap or something like that? It's not rocket science. All you have to do is get the Fed out of the equation, allow the free market to work, allow sound money principles to where our currency wasn't losing purchasing power every single year, and then let the deflation improve the lot of the poor and middle class. And oh, by the way, during that time frame, real interest rates that you could get in a bank account, Kevin, were 7%. 7%. So there was no need to go out and speculate. There was no need to really take risk. You could just put your money in the bank, and your money would increase in value and purchasing power by 7% per year. Compound that over 20 or 30 years and see what you get. We wouldn't need Social Security. We wouldn't need government intervention, and we wouldn't need to push people further and further and further out the risk curve. Not only the average Joe and Jane, but these financial institutions. I mean, we were going to talk about something with Citadel that was on a hot topic on Reddit. But when you text me, one of the things that I text you back is that, yeah, I mean, listen, I'm not sticking up for the banksters or Wall Street or anything like that, but you got to go to the root cause of what they're doing. And they're taking exponentially more risk because the Fed has dropped interest rates down to 0%, and you can't get a return anywhere else. So let's point out how bad the symptoms are, but let's not forget the cause.
That's really interesting. Yeah, I mean, that's really a thought that is not taught or really considered here, because what you've just described is, hey, deflation is good. It increases your purchasing power, and you can actually end up making more money over time staying at the same job. But I want to challenge this. Is that what society is trying to do? To say that, hey, just stay where you are in life and end up making more? Or is the whole purpose of kind of what we've built, this culture of get out and provide more value for society, get a better job, get a better education, provide more value, and you want to make more, do more, as opposed to stay stagnant? Isn't deflation kind of incentivizing stagnation on a wage level, kind of what you've described? May as well just stay at McDonald's then, because, hey, you know, I'm on the up here, versus really encouraging innovation.
Well, you're always going to have animal spirits, in my opinion, if the government gets out of the way, if you have sound money, and if you have rule of law and private property rights. You know, human beings are always going to want to better themselves. I mean, you're a great example of that. I mean, you could retire right now and never make another YouTube video for the rest of your life, and enjoy your kids, enjoy your wife, enjoy the rest of your life. You could move, you'd buy a desert island somewhere, but you don't. Wake up every single morning, you try to make not only more YouTube videos, but you try to improve the videos you're already doing. Why do you do that, Kevin? It's because
I think I'm crazy.
well, you may be, but I'm crazy too. And all of us, if you think about it, you know, when you've been able to achieve something in your life, you rarely sit back and say, okay, that's it, I'm done. I guess I can go ahead and hang her up. I don't have to get out of bed in the morning anymore. No, we just continue to want more. Now let's go back to what you were saying. It incentivizes savings. So what happens when you have more savings in a society? Then there is more capital to lend to those entrepreneurs that want to create goods and services that, like you, are unbelievably motivated to go out there and improve your lot in life, improve the lot of your family, but at the same time, through the invisible hand that moves the market, improve society at large. So there's more pool of capital. So we don't have to go into debt. We don't have to create derivatives. We don't have to have the repo market and all these crazy things that create this boom bust cycle. We can actually lend to entrepreneurs through other people's savings, and it's a win-win.
Yeah, I mean, I guess in that case, the entrepreneur would just pay a higher interest rate, because if savings rates back then were 7% and say you got paid 7% on your savings, then obviously the entrepreneur who wants to go borrow and start up a business is probably going to pay like 13%. But isn't that potentially punitive to somebody who's wanting to get started with a new business or has an idea? I mean, isn't that just going to kind of put the boot on their neck, so to speak, in terms of their ability to get ahead and innovate?
Well, the more savings you'd have, the lower the interest rate would go.
Okay, so maybe explain that, because I'm thinking, I was thinking, if people are earning, you had mentioned that people were earning 7% on their savings.
Real 4%, and then plus the 3% deflation.
Gotcha. Okay, so but now if I'm going to lend that money out, I would have to get compensated for that risk, so the rate would have to be higher than the savings.
Yeah. So let's just say it's a 4% nominal rate. So let's say you're lending it out at 7% interest rate. So your point is, today you might be able to get that same loan for a 3% interest rate. So doesn't that incentivize entrepreneurs getting out there, because it kind of lowers the bar? Well, what I maybe to a certain degree, but you have to do a cost benefit analysis. So what that also does is it reduces the amount of cash flow that you have to make in order to service the debt. Therefore, that business is going to be less stable. I mean, just think about it. Just think about if interest rates were 30%. You know, let's go back to Volcker in 1981, where who knows what a business loan would have been back then. But let's just say it was 25, 30% or something like that. How amazingly solid would that business have to be in order to take out debt? Your cash flow would have to be astronomical. So so you've got to contrast the two. Another thing that I would argue is that those businesses, even at a 7% rate, are going to be far more sustainable, because they're being built on the savings of the population as a whole. Therefore, if they're selling a product, that the demand for that product isn't coming from a government stimulus check. The demand for that product is coming from productivity and savings, and that is far more sustainable than anything that the government is handing out temporarily or permanently, because permanently, then that's just going to decrease the purchasing power of people's savings or of their wages, and you get back into that downward cycle that we've seen from the Fed since 1913 as well.
Two things out of what you just mentioned. One, it's really interesting what you said about a business that has the capacity to pay that 7 or even 30% interest rate. They're going to be a lot more stable than a business borrowing at, say, 1% or 0% teaser rates, right?
Yeah.
And actually, that hit home a lot, because when I first hired employees was when I was doing a licensed contracting division of my real estate company, and it was horribly low margin. Like it was basically a money losing part of my real estate business. Like real estate, really high margin. I could hire somebody for real estate and no problem. There's plenty of cash flow. Go hire somebody for construction. It's like, dude, I need lower interest rates, man, because this business is tight. So
Right.
it's almost like the less profitable. I mean, that just totally hit home. The less profitable the business, the tighter it is to expand and hire.
Yeah,
So
Kevin,
that's
let's go back to the GFC. Let's go back to the
yeah,
GFC. What was the big
yeah,
problem there? We were giving people loans that couldn't afford them.
right.
That's the
Yeah,
bottom line.
ninja
Look what
loans, right?
that did to the housing market, right? Well, if
Mhm.
if interest rates on mortgages never would have gone below, let's say 10%, would we
Yeah.
have had a housing bubble?
No way. Nobody qualified.
Right. So, or someone that did, let's say that and so here's another thing. If you look at a chart of housing prices going back to 1900, adjusted for inflation and size, you'll see that for the first 100 years of the or not the first 100, but that 100-year period in the United States, housing prices didn't go up. They pretty much
Wow.
stayed the same when you adjust for the size and you adjust for inflation. So then, of course, in the early 2000s, we see it just go parabolic, as
Yeah.
everyone knows. And so why was that? Why didn't we see any of these massive housing bubbles that we've seen in the 2000s? Call it. Well, because the stipulation for getting a mortgage was pretty much standard and had remained the same for 100 years. You got to put 20% down, and interest
Right.
rates on a mortgage probably right around 7-8%, something like that. So you get a housing market that is healthy, because the people who are buying homes can actually afford those homes, and you're not creating this
Wow.
bubble. You're not creating artificial demand. But what happens when you bring in all of these new loans where you don't have to put any money down and you don't really have to show that you have a job or you don't have income? Sure, it creates more demand, then the prices go up, but it's unsustainable, and it creates this boom bust cycle. And it's the exact same thing with business lending, or going back to what we were saying, it's the exact same thing with corporate debt, which now the Fed is basically doing to corporations what the banksters did to the general public back in 2005 and 2006, making them, or not forcing them, but allowing them to go out and take all these loans that they could not afford, they couldn't pay back. So when those rates adjust, it's the same thing with corporate America now. When those rates go back to a market rate, boom, they're done. It's just like the Joe and the average Joe and Jane with their house that they couldn't afford back in 2006 to 2009, call it.
Wow. Yeah, so I want to touch on the housing, and then I want to hit those corporations. So what do you think about the housing market now? I mean, one of the things that I'm studying a lot of the housing market is I'm noticing that right now, at least, more and more qualified people are getting into homes. Just because there are so few homes, the lenders kind of seem to be skimming off the top, and they're taking those people with those 800 credit scores, those probably the dual six-figure earners, right? Everybody else is getting screwed. I mean, to me, what it sounds like is the rich are getting richer. And I have this theory that in the future, people aren't going to own homes anymore. It's going to be, the wealthy 10% of people are going to own all the homes, and everybody's going to rent from them. It's just a long-term concern that I have, just sort of on the trajectory that we're on. And it's somewhat what we're seeing now with the data. I mean, only people who are really well off are able to buy homes right now. Everybody else, sorry, you can't qualify. What's your take? I mean, is it not sustainable, or is it sustainable because qualified people are going for them, or what's going on there in housing?
No, it's not sustainable, because the mortgage at the end of the day, no matter how low the rate is, unless you really go negative, is a function of people's income. So if incomes are not going up in real terms, then how do housing prices continue to go up? Well, you've only got one part of the equation there. The supply has to go down. And so if we could see supply shrink, I think that's definitely realistic. I just talked to someone just the other day about what it's costing to build new, and it's staggering, unbelievable.
Oh, it's insane.
When I built
You can't build new.
Yeah, I mean, I built a new project back in 2013 that just for the construction, this was Portland, Oregon, cost me about $130 a square foot. Now you can't do it for under $230 a square foot. So, and then people always get fixated on prices going up as though that's a good thing. You hear in the media that, oh, prices are going up. That's great. Well, it's great for people who own houses, but it's not too good for people who don't own houses.
Yeah.
So then it just increases this wealth gap. And, quite frankly, that goes back to the Fed as well, because see what you do when you push people into speculation by inflating away the value of their savings is you create an economy that's built on asset prices.
Right.
You see, so if you don't own assets, well, you're screwed. You got no way to get ahead. And so that by very definition, that's going to increase that divide of the people who own assets and the people that don't. That's increasing the wealth gap. Again, that's a symptom that most people just look at the symptom, but they don't look at the cause. And when you look at the cause, it goes right back to the Fed, back to artificially low interest rates and inflation.
Well, why change it? I mean, hey, look, you get it. I get it. The people watching this video get it. You want to get ahead in America, businesses, real estate, stocks, assets, right? So just invest in those and call it a day. Let the Fed keep printing, let the inflation happen, and hey, we're all set. But what's wrong with that?
Oh, I'll tell you what's wrong with that. Let's just say that you go to, well, let's say you buy that desert island we were talking about before. Okay. But let's just say this scenario, there's no way off. You get shipwrecked or something on this desert island. And let's say that you've got a chest full of money. You've got $1 billion in there, but you're on this island. All you got sand, water, and some coconuts. Are you rich?
I'm broke, man. That scenario.
No, because you got nothing to buy. You can't eat. You got to live in some palm leaf shanty that you just build just to keep out of the rain. So you're extraordinarily poor. So my point is the wealth of a society is not, when you really think about it, it's not measured by the amount of money a society has, or else Venezuela would be the richest country on the planet Earth. Right? It's measured by the amount of goods and services it can produce efficiently. So what you're talking about is this scenario where the Fed or the government just keeps spending more money and more money and more money and more money. And if we don't get, or until a time in which we get significant inflation, well, who cares? What you're not thinking through is they're distorting the economy. They're creating misallocation of resources, malinvestment, which over time is going to hollow out. I mean, it's not going to, it already has hollowed out our manufacturing base. So every single day, every single year, we produce less. We produce less and we have to print more money. Well, if you're producing less goods and services, but printing more money, it doesn't matter what the number in people's bank account is, or if it's going up, they're going to become poorer because we're producing less stuff.
And that's because just, I mean, I'm trying to relate this to the individual because what do I care if the aggregate produces less if I got more money that I could go use to buy more Xboxes?
Right, because if you live in Venezuela, as an example, and you can't get out of the country, it doesn't matter how much money you have. It doesn't make, listen, you could have $1 billion worth of Bitcoin in Venezuela, and you still can't buy anything. The grocery stores are still empty. You still can't get toilet paper. I mean, well, let's go back to 2020 in the United States. How you could have all the money in the world. You could be Bill Gates and you still couldn't get toilet paper.
True.
You see, so that's just a small example of what things can get to if the Fed and the central planners continue to distort our economy and make us less and less productive.
But I mean, is that like just the, coming from a slippery slope argument? I mean, isn't it possible we could continue down this path? And like, I mean, at least in the short term here, it feels hard for us to individually connect to that. Like, yeah, we had that toilet paper shortage, but that's not happening frequently. I mean, how does, and I'm playing devil's advocate here.
Yeah.
How does a hollowing out of the manufacturing sector affect me? I don't care if my Tesla is produced in Shanghai or in Fremont. I just want it to be cheaper.
Right, but think about that. What you're doing is you're trading Teslas for, you're trading the Chinese Teslas for dollars, or you're trading them whatever. So what do they do with those dollars? They buy U.S. assets. We'll take that to its logical conclusion. The Chinese own everything. We own nothing.
Well, what's wrong with that?
Well, you don't have much leverage. That's for sure. But let's look at another real life example. I've been in Tucson the last week, just in a hotel room, as you guys can see here, and I'm just getting ready to go to Puerto Rico. Well, I was in Tucson about maybe 3 years ago for a few months, and I used a lot of Ubers in what I was doing. And I mean, I would at the most wait 5 minutes for an Uber. It doesn't matter where I was around town, the maximum 5 minutes for an Uber. Now I'm lucky if I can get an Uber in 45 minutes. I mean, it's staggering. Every single time I go on my phone and try to get an Uber, it says no cars, no cars,
What?
no cars,
Why?
no cars available, no cars available. Because no one wants to drive Uber, because they don't have to drive Uber because the government's paying them to stay home.
Really?
And well, it's not just that, because I've talked to a lot of these Uber drivers. I'm like, why isn't anyone driving Uber anymore? And if you Google it, you'll see that even the Uber executives have stated that this is a really big problem, that they just don't have the drivers anymore. Well, number one, you're requiring people to wear a mask if they drive. So if they don't want to do that, they're like, screw it. Then what they're also requiring, and I've heard this from a lot of Uber drivers, is they're maybe this is just in some states, I don't know, but they're saying that they require hand sanitizer. And what was happening is all the people in the back were stealing the hand sanitizer. So it was just taking away their margin to where they weren't making any money because they're just supplying the customers with hand sanitizer. But then also too, people are being paid to stay home. Kevin, did you know that from Q2 of 2020, from Q1 to Q2, the incomes in the United States went up by 30% on average. 30%.
The personal savings rate, right?
Well, but think that through. That's when the unemployment rate was getting to a level that we last saw in the Great Depression. But yet incomes are going up by 30%. And even in January, incomes went up by another 10%. So incomes now are far higher than they were in 2019. But yet the jobs market obviously is a lot worse. I mean, this job market that we see now, we haven't seen anything like this since the worst part of the global financial crisis back in 2009. But yet we see incomes going up. So my point is, people right now just really aren't incentivized to go in there and get into an Uber. So then you have less productivity, you have less people providing that service, and you have less economic output as a result of the central planners getting involved and these unintended consequences.
Now, is that just a necessary evil for helping all the people who truly need help, whether that's the restaurant sector or hotels or travel? I mean, there are a lot of people who just straight up lost their jobs. And I mean, isn't it the role of government, and maybe this is putting on the Keynesian hat, right? Isn't it the role of government to step in and provide when the economy's doing poorly and to take away when the economy's running hot?
Well, first of all, I would say no. It's not the job of the government. It's the job of the individual, and it's the job of your family. It's the job of the community. That's what always works best. Whenever you have, you had a lot of tops-down, let's say, welfare in communist Russia, and it didn't work very well. Why is that? Because the central planners that are all the way over there in DC, they don't know what your local community needs are. So it's better that we could keep more money in the pockets of the individual, I would argue, by taxing them less and less regulations and creating an environment that is conducive to productivity and allow the individual to take care of their family members and the others that are there in their community, church, etc. I think that would be superior. But your argument is, listen, we have this pandemic and people are out of a job. What are you going to do? So the government's got to give them money, or you're going to have people out there starving on the street. Well, even if that is the argument, okay, do we need, what are we on now? I mean, you would know this better than I would. Are we on round 5, 6 with the stimulus checks? Do we need incomes going up by 30%? It's because at a certain point, you've got to say, okay, well, now the government is competing, or the employer is competing with the government for employees, because the government's saying, hey, we'll pay you this much to stay home. So the employers are like, okay, well, what do I do? And if you go and talk to a lot of restaurant owners and a lot of people, I was just at my mechanics the other day, same thing. They're like, it's impossible to find people right now. No one wants to work. And again, I'm not saying that, those stimulus checks or whatever didn't do some good and have a need. I'm saying there's a cost benefit analysis that we need to do to have an intellectually honest conversation about stimulus and government spending.
So how would you have handled this pandemic? I mean, when the crisis rolls around in March, the Fed doesn't come to bail out corporate bonds. The Fed doesn't come out to do QE infinity. The market would have kept falling. It's very likely the banking sector would have seized because banks would have stopped lending, which is one of the roles that the Fed plays, at least, is keeping liquidity flowing. So then you get liquidity not flowing anymore. Now all of a sudden people's credit cards get closed, their credit lines get closed. Basically, every American who doesn't have a 6 to 12 month emergency fund of cash around probably going to be hurting pretty bad. Wouldn't you say that that's going to be a whole lot more suffering than just let the Fed come in, let them keep liquidity rolling, and let's just worry about this at some point in the future?
Yeah, it's a great point. And it all depends on whether your time horizon is short term or long term. And so as an example of this, let's go back to the late 1918 or so, 1919, appropriate enough, during the Spanish flu. And actually, let's take it back even prior to World War I. You had two philosophies. You had let's say the United States and Germany. Okay, both countries had to, let's say, we'll call it print money. They had to create more currency units in order to fight the war. And both countries continued to do so after the war. But in both countries experienced a significant amount of inflation. But what happened in the United States, or I don't know the exact year right off the top of my head, it was maybe 1918, 1919, they stopped. They said, no more money printing. We're not going to do it. This is going to we're on a slippery slope right now. And the argument was kind of what I'm saying. So what happened in the United States? We had a massive depression. The headline numbers were just as bad as the depression that we saw in the 1930s, the Great Depression. But the government stood back. They did nothing. And there was some serious, serious pain. Unemployment levels skyrocketed. All the things that you just talked about pretty much happened. To a lesser degree because there wasn't as much leverage in the system, of course. But then you had a true V-shaped recovery. And 2 years later, all of that malinvestment was cleaned out of the system, and we had a new slate to start from, and then we really took off, and then you had the 1920s, the Roaring Twenties. Now let's juxtapose that to what Germany did. Germany never wanted to take the pain, just like you said. They didn't want to force their society to go through that. They didn't want to take the medicine. So what did they do? They just kept printing more money and printing more money. And it got to a point in the 2021, where a lot of economists were looking at Germany and saying, look at this. They did the right thing. Those crazy Americans with their austerity, look at what they did. They destroyed their economy, and they didn't have to do that. But then what happened in 1922 and 1923 in Germany?
Well, hyperinflation and the wheelbarrows of money. But I'm going to ask you, was that due to the money printing or a loss of trust in the government, basically, before the Third Reich?
Well, no, that's just from money printing. Because what happens is when you're printing that amount of money, in the beginning, it's great. Because the value or the price of goods and services isn't going up at the same rate. Right. But what happens is there's a line in the sand that's crossed where the prices start going up even higher. Then what comes into effect is something called Gresham's Law, where the bad money chases out the good. And just that's a way of saying that when you know that dollar in your pocket is going to be worth a lot less tomorrow. And once this dawns on the psychology of the general public, they go out and buy anything. They buy food, they buy lumber, they buy cars, they buy anything to get rid of these dollars that the government is creating. Okay, well, that feeds on itself, And then that's where you get this exponential curve where the currency is losing purchasing power so quickly, but yet the government has no alternative but to continue to print more and more and more and just add zeros to the end of those bills, and then the entire thing collapses. We've got to go back to what we're taught in third grade. There's no free lunch.
Well, yeah.
There's just not. So if the government if what we see right now, you'd scratch your head and a 10-year-old would say, well, wait, that kind of seems like a free lunch where we can just print money and give it to people and they don't have to work to get the money. Right. That 10-year-old is correct. And then you've got to think through, okay, what happens? And it goes back to your point. Yes, in the short term, that will definitely smooth things over and we'll have a lot less pain. But my point is at some time, you're going to have to pay the fiddler. And do you pay the fiddler now and take this much pain? Or do you pay the fiddler in 5 or 10 years and take this much pain? You know, the choice is we should have taken the pain back in 2001. We should have taken the pain back in 2008. But we continued to kick the can down the road. And every single time the problem gets bigger.
Now, the paying the fiddler here is really implying that at some point there's going to be this big hyperinflation. Isn't it possible, though, that, like you said, you know, if it weren't for the Fed, we'd have deflation? Isn't it possible that they just perfectly calibrate that money printer to where, deflation is, you know, minus 2%? Okay, let's print at 4% inflation, and we'll just hang out there at 2%, or whatever arbitrary number they want. They want to go to 1% or 3%. At that point, it doesn't matter. But couldn't they calibrate to that level to where, yeah, I mean, third grader, sure. Is it weird that we printed all this money and we didn't see inflation? Yeah, but let's talk to you about deflationary dynamics and how we're offsetting that. Isn't that possible too?
Well, let's think about that. What you're doing, what you're assuming is that the Fed has the ability to just micromanage things like a thermometer. Like they just, that's 69 degrees. That's a little cool. Let's bump it up to 70 degrees. I'd like to remind you that they've been trying to, by their own numbers, they've been trying to hit 2% inflation for the last 12 years. Haven't been able to do it.
Can't do it.
So if they haven't been able to do it over the last 12 years, how can they micromanage it over the next 10 or 12 years? And then let's go to Japan. And I think a very interesting thought experiment is, I don't know if many of your viewers understand or know this. It's probably kind of esoteric macro stuff. But the Bank of Japan owns about 60% of the outstanding JGBs, which are their version of treasuries, the government debt, right? So in the macro space, one of the thought experiments that's kind of popular right now is trying to figure out what would happen if they just deleted the debt. Because if you think about it, that's an asset of the central bank
that they owe themselves.
And it's a liability of the government, but those are the only two parties involved. That's it. Yeah. So if one morning some guy came in and accidentally hit the delete button, would anyone even know? You see? So then you say, well, if the answer is no, well then why doesn't the central bank just continue to buy all of the debt? And Japan hasn't experienced this huge bout of inflation. It's been kind of a consistent deflation thing, which might not be that bad considering the Weimar Germany alternative or Venezuela alternative. And then why don't we just keep doing this until things improve, and we'll just keep kicking the can down the road and it's not that bad. Here's what that argument misses. And this is what I've tried to think through a lot. The damage in doing a debt jubilee isn't necessarily that the damage comes in the future or at the time of the debt jubilee. The damage has already been done by the government spending the money in the first place to get Japan up to 250% debt to GDP. You see, let's go back to what we were saying about the government spending and the Fed distorting the economy, creating a less vibrant economy that produces less goods and services. We know in Japan, they have all these zombie corporations, zombie businesses. They really don't do anything, and they wouldn't be there. We don't have Schumpeter's creative destruction in order to get that economy really running on all 8 cylinders. You see? So that's what they've done. They've destroyed their economy through the government spending in the first place. So, the example I use, Kevin, it's a lot like a heroin addict that before they're an addict, let's say they get a credit card for $100,000, and all they do with that $100,000 credit card is buy more heroin, and they make themselves less and less healthy by doing more and more drugs. Well, let's say they've maxed out their credit card. So now, and then we come in and give them a debt jubilee to where we wipe the slate clean. So now they've got another credit card with $100,000 limit. Are they in any better shape than they were before? No, because the damage has already been done. In fact, they're in worse shape because that heroin addict, i.e. the government, is going to think that they just had a free lunch, and they're going to spend more and more money, distort the economy even more, just like that heroin addict buying more heroin until they kill themselves. Wow. And it's the exact same thing with the government spending. Let me give you another statistic. Prior to the Federal Reserve, the government spending was about 3 to 5% of total GDP. And I don't think anyone on this live stream would argue that the government spends money more efficiently than the private sector. Just go down to the post office as an example. So now government spending is almost 60% of GDP. 60%. So think what that's doing to not to retard the growth of our economy when 60% of it is due to government spending, like the post office, and you could go down the laundry list of things that the government makes less efficient, and then take that to its logical conclusion as a thought experiment. Well, what happened if the government was 100% of GDP? Well, then we're right back at communist Russia. And we know how great life was during the 70s and 80s in communist Russia compared to the United States. You see, so that's, I think, what you've got to think through when you're trying to figure out not just the short term, but the long-term consequences of government spending. It goes back to Hazlitt, who was a very famous economist in the Austrian school. And he always used to say, you can't just look at the seen. You've got to look at the unseen. That's proper economic analysis.
Now, the 60% government spending, isn't this just a temporary thing? I mean, who says that just because it's at 60%, it's got to trend to 100%? Can't, when the economy's booming again and Apple's booming at the same time as Carnival Cruise Lines is booming, can't we get to this point where government spending is 20% of GDP again?
Well, let me preface by saying prior to the pandemic, government spending was right about 45%, and that's state, local, and federal. So it's not like it went from 10% up to 60% where it is today. But I mean, my pushback there is they're in a what Schiff calls a monetary roach motel, where once you go in, you can't. It's like the Hotel California. You can come in, but you can never leave. And it's the same thing that we saw with quantitative easing. Remember when Bernanke came out and talked about QE in the first place? He didn't come out and say, hey, you know what, guys, we're doing QE1.
Yeah, sure.
He said, no, we're doing QE.
Yeah.
You see my point?
It was supposed to be temporary.
It's supposed to be just one-off. But no, we get 2, 3, 4. Now we're at QE infinity. Because what you've done is you've built an economy around quantitative easing. Therefore, you get to a point where you can't take that quantitative easing away. And it's the exact same thing with government spending. Once you get to a point where you build an economy around the government spending, you can't just rip the carpet out from underneath the whole economy, or it's going to implode. Let's go back to Venezuela. What was the problem there? They built their entire economy around the production of oil. So what happened when the oil price went from 100 down to $25 a barrel? Well, they had to start printing money to make up the difference. The economy couldn't create stuff. It wasn't vibrant. It wasn't dynamic because it was a one-trick pony. And there you get the hyperinflation. So what we've done is we've built our entire economy around asset prices, and debt and confidence. Those are the three things I always outline. But really that goes back to we've built the economy around continually increasing government deficits and government spending. So I wish there was a way that we could wave the magic wand and say, okay, it's at 60% now. Let's just gradually pull it back to 20%. But look at what happened when they tried to do that with quantitative easing, when they did QT. I mean, you were right there doing videos on it. Remember, Jerome Powell tries to reverse it. They say it's going to be like watching paint dry.
People were pissed.
You tell that, well, people, the market. Remember what happened? Remember what happened to the stock market? And they had to reverse course and start doing QE again. Then we get the repo spike, and then we get what we see today. So I wish there was a way that we could gradually decrease it, but I don't think there's a way we can, because in my opinion, we've built the entire economy around that government spending and Fed intervention.
Yeah, I guess their argument has always been that, oh, at some point the economy will be strong enough and we'll be able to taper. But I remember the tapering very clearly. I mean, when they started increasing the Fed funds rate, interest rates on real estate bumped like we were up at 5% on the 30-year for a moment, and we shot up from like 4%. Real estate prices dropped 10 to 12% like that. It was like a matter of a month, and real estate prices plummet. And then, of course, that winter, the stock market sold off until Jerome, officially reversed, like you said. So, yeah, I mean, getting out of the QE, that'll be interesting. But I got to challenge the idea of hyperinflation. Isn't it possible that hyperinflation just comes from a loss of trust in the government relative to other governments? So is it possible that society just trusted the Weimar Republic right after World War I less than the United States and the United Kingdom, or Zimbabwe today, or Venezuela, not too long ago, less than people trust in the USD or the euro?
So you're saying that it was the Weimar Germany could have been a result, or the hyperinflation, of them just losing trust in the government?
Yes, of people losing faith and confidence in the government. Yeah.
Yeah. So my rebuttal there would be, if you look at 1920 to 1921, the end of 1921, what's fascinating, and there the money growth was just staggering, far more than what we see in the United States. I actually did a video on it the other day, but oddly enough, and this was the time when the United States, they went into austerity, and they were going through that big depression that we talked about in the early 1920s, the one that most people forget. The value of the German currency, we'll call it the mark, I think it was the Reichsmark, something like that, went up against the dollar. It increased against the dollar all the way to like the beginning of 1922. So there was not just confidence in the German economy. I mean, there was hysteria. I mean, people thought it was an economic boom, the likes to which they had never seen before. And that's one of the reasons.
I just want to interrupt there really quick. Is that possibly, though, because if you print money, you buy more potentially of your own bonds, your currency denominated bonds, which drives the price down, which increases the yield, which leads more people to be interested in your currency? Is that possibly a reason why?
Well, I mean, the point I'm trying to make is that they were printing the money supply was increasing massively, while at the same time it was increasing in value against the dollar. And so, I'm not sure the specific dynamics as far as their interest rates. But one thing I can tell you is that the confidence was not lost in the government until the very end. And the confidence was not lost in the economy. I think that's one of the catalysts, actually, Kevin, for them getting into that hyperinflation mode, is the banks really started to lend. Because that the banks are in charge of most of the money creation. Usually, it's the government and the banks. But I think the banks really kicked it into high gear, and that could have been the straw that broke the camel's back with Weimar Germany. And so I don't know that it was just a loss of confidence. I think that it comes from the purchasing, that people just intuitively, a completely different mind shift, where people are just, let me give you another good example. I was listening to Russell Napier yesterday, and he is someone that was a young person in 1970, probably a teenager, maybe in their 20s, something like that. But he worked for, and now he's a very famous economist, and he worked for his father's butcher shop. And he remembers vividly that they would have, his job was to go out every single morning and wipe down the dry erase board in the front of the shop and put up the new prices, because that's how fast prices were increasing. And that's when it really gets into the psyche of the people. And he contrasts that to the other day. He went to just a fast food restaurant, and he noticed that the fast food restaurant bought their menu, that you see up on the board there, but they bought it so you couldn't change the prices. And he said, isn't that interesting? That really tells you how the mentality of the general population has gone from an inflation mentality in the 1970s to now just prices are always going to be the same for the rest of eternity. And the prices in Weimar Germany were the same all the way through the beginning of 1922, and then things changed. And it can change on a dime. And I think the one thing we definitely agree on is it has a lot to do with human psychology.
Yeah. Well, I mean, that's interesting, though, because, I mean, inflation expectations can drive inflation. I mean, do we then as a society just, because this is what I'm conflicted by, is it seems like everybody's like, oh my gosh, there's inflation everywhere. Lumber prices, sheet metal prices, everything's up. Oh, there's inflation everywhere. But then I also don't see people exhibiting behaviors that actually leads me to think that people think inflation will stay.
Correct.
It seems like people think we're going to go through this period of high inflation and then things are going to settle back down. Isn't that possibly the case here? I mean, maybe we're not at that dime yet.
No, we're not. No, and let me be clear. I'm not predicting that we're going to go into hyperinflation next year or anything like that. I'm not even predicting that we go into hyperinflation. The dynamics there, especially because the dollar is the world reserve currency, would be incredibly, incredibly difficult. What I am saying is that and there's no certainty, it's only probabilities. Based on what I see as the probabilities, there's a good chance that maybe in 5 years, 10 years, we get back into that kind of 1970s mode. But to your point, right now, psychologically, people just aren't there. And it's going to take a lot of time to kind of gradually change that psychology. And what makes it tough to predict is it goes from an economic question to a political question. Yeah. And who the hell can guess what these politicians are going to do? Because in order to get to that point where they're creating enough additional money supply, like they did in 2020, I mean, I'm sure you've covered this, where M2 money supply in 2020 in the United States went up by 25% in 1 year. I mean, that is staggering. And to give you some context, during the World War I and a little after, when Weimar Germany was sowing the seeds of that hyperinflation, their money supply was increasing by about 50 to 60% per year. So we're not there yet. It's very close to those levels. But in order to create the type of additional money supply, or currency supply, I should say, chasing those goods and services, it would require the government to just increase the deficits year after year after year. Now, I think there's a good chance they do that because of what we talked about earlier, and that now the whole economy is that's the lifeblood of the economy now, is government spending. So I don't know how that's reduced. I can only see it really, I'm sure there's a way that they could reduce it, but I think the probabilities are high that they continue to increase it. And see, again, it's like a drug addict, where if you take the same amount of the drug, you start to get less and less effect. In order to get the same or increase effects, you have to take more of the drug every single time. And obviously my analogy here, the drug is government spending and money printing. And that's where I think that gradually you could get to a point where they are creating enough additional currency units chasing those goods and services to get that continued inflation, that it starts to sink in and change the psychology of the average Joe and Jane.
Yeah. I mean, certainly when you look at what even we're planning to spend this year, and who knows what's going to come in the second half of the year, but we just look at the first half, $1.9 trillion stimulus, potential $4 trillion infrastructure package. There's already almost six T's in the bag on top of the ordinary deficit spending.
Yeah.
So,
and then
what?
And another thing too, Kevin, is that's just looking at the demand side of the equation. We're not looking
Right.
at the supply side of the equation. And what happens is, let's just take it to an extreme and think that the government pays enough people to where, let's just say 50% of the population decides not to go back to work. Well, then what does that do to goods and services? Then it massively reduces the supply of goods and services. So even if incomes or demand stays consistent, the prices will skyrocket because of the decrease in the supply side of the equation. So we got to think through that.
What are your thoughts on the velocity of money? I mean, obviously, it's plummeted during the pandemic, and this makes sense because people are stuck at home, right? But are we going to see a return to the levels we've had before? I think M2 velocity used to be like 1.4. It's been trending down just year after year, down, and now it went to like 0.9. I mean, like a substantial just plummet down. In my opinion, with all this money printing we've done, if we sort of reverse engineer it, if we just tomorrow went back to money velocity of 1.4, it'd be like 30% inflation. Things would just go nuts. But I don't think we're going to go back to that very quickly. What's your take on that? Are people just going to spend less? Did people put all their money in Bitcoin, NFTs, and YOLO options, and the money's just sitting on assets?
Yeah, I mean, I think that's a really interesting kind of concept to think through. And I agree that there's pent-up demand, but I don't agree with those people that there's just huge pent-up demand, because you can only eat so many steak dinners. And if you didn't eat 40 steak dinners, you're not going to go out and eat them in one night, let's say. So, and then I don't know what happens with the restrictions either. I don't know that. I don't really see an end game there. And I know you probably don't want to get too into it because YouTube will kind of slap us on the wrist there. But the other day I was walking in a Whole Foods, and I was just, right from the second you walk in the door, they're just beating you over the head with, do this, do that. And I'm not going to say the words because, we'll get dinged there. But everyone knows what I'm talking about. Do this, do this, do this, do this, do this, do this. And I thought to myself, what would have to happen in order for them to pull back those restrictions? Because my sister, as an example, lives in Texas, where they pulled back those restrictions. And I called her like a week later and I said, hey, what's changed? Is it back to 2019? And she's like, no, it's the exact same. It's the exact same. The behavior has not changed. The businesses, the ones with the sign in the window, the Whole Foods that are beating you over they're still beating you over the head. Even though from a legal standpoint, there's everything has been lifted. So then you kind of scratch your head and you're like, okay, well, what needs to happen here? And I don't know. So how long this situation lasts to where we've got this low velocity, I think that's a very, then you take it from, that's not really an economic question. It's not even a political question. But now it becomes a behavioral psychological question, and my goodness, it's anyone's guess. Who knows?
Oh wow. Okay. So I guess then I want to circle to the suing the Fed thing again. You're suing the Fed. Obviously, you believe that the Fed has created these massive distortions, particularly disincentivizing people from working, creating or maintaining zombie companies that should have just gone bankrupt, but now can subsist because they're basically bailed out by low rates. What part of the law do you look at? Like, what does the law say? I don't know. Forgive me for being ignorant to this, but what's the law that you're pointing at that says you're breaking the law here?
Yeah. So no, it's a great question, and it gets very nerdy and kind of esoteric. So you got to look at this in two phases. And the lawyer I'm kind of partnering with is a guy named Robert Barnes, and he's a constitutional lawyer. He's got a lot of experience in these high-profile cases. So what we're doing is stage one, you request the information. So you say, listen, Federal Reserve, we want information. We want everything going back to 1913, let's say. And but any information
are they subject to FOIA?
There you go. Boom. There you go.
Oh,
that's it. So we request the information, and most likely they're going to say no, pound sand. And then you have to sue them under FOIA, which is the Freedom of Information Act. And so then if you win, then, that's kind of stage one. That's what we're doing right now. Then if you win, then you get all of that information from the Fed, everything you ask for, going as far back as you request. So Robert has implied that he wants to go all the way back to 1913 and get every single document and sit there and analyze it. Then what you do is you see if there's anything that they've done that is that's a violation of the Federal Reserve Act. And I think that just in my lifetime, the main thing that I saw is back in March and April of 2020, buying the corporate debt to that special purpose vehicle. But maybe there's more. Who knows what you find? And then you gather the information, and then you see if there's anything actionable.
But wait a minute.
If there's anything actionable, then you take it to the next step, and then you sue them for violating the Federal Reserve Act. Sure,
but like I can't FOIA Apple, and technically the Fed isn't part of the government.
Yeah, so, so there's been cases where they've been sued under FOIA in the past, going back to I believe it's 2010. I think Bloomberg that was the first one to do it, and they actually the judge or the court ruled that they were a part of the government and fell under FOIA. So there's precedence for this. We're not just throwing a Hail Mary here.
Okay, got it. And then, so it'll really come down to whether or not you'll be able to pull some info out of them. What are you expecting to come out of this?
Well, a lot of things, I think. First and foremost, we just want to create awareness. Yeah. Because, I mean, this has been a fantastic conversation that we've had over the last hour that probably opened people's eyes to some things that they've never thought about. And maybe they'll think about, okay, well, what does this central bank actually do? And I mean, the media tells me that they're a good thing, but maybe I should think a little more critically about that. Yeah. And maybe I should research it. So that's the upside number one. And then second, if you're able to do, even if you're able to win the FOIA, then that sets another kind of, it sets a bar to where other people in the future know that, hey, this is possible. And, it kind of, in a way, constrains the Fed, because they're like, oh, shoot, now we've got all these people that have won these cases. So we need to understand that in the future, it might be likely that we'll have to disclose everything we're doing behind the scenes, who we're doing it with, what countries we're maybe dealing with that we don't want to admit, what banks that we're dealing with, what politicians, who knows what you find. Yeah. But maybe they're a little more careful. But then ideally, you'd give the Federal Reserve Act the teeth that it has had for many years, to where the Fed and the central planners in general realize they're not above the law. And
what in that Fed Reserve Act says they can't buy corporate ETFs?
Oh, well, I mean, nothing in there gives them the right to do anything other than buy treasuries.
Oh, I see. Okay.
They
That's
can't,
the argument.
Yeah, they can't come in and buy corporate debt. They can't buy equity. They can't buy stocks. They can't do that. The Federal Reserve Act says that you can and can't do bam, 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 or you can do this. And they just went right around that in March. So that's my big beef here. I mean, it'd be one thing if the Fed has created all of this damage and has exacerbated the wealth gap, and really, in my opinion, made the lot of the poor and middle class a lot harder over the last 100+ years. It'd be one thing if they did that while abiding by the law.
Yeah.
It's a whole other thing when they're doing that by breaking the law and violating the one document that is meant to constrain them. That's what the Federal Reserve Act was meant to do, constrain the people, the men and women who are running the Fed. So the way I see it is that document, the law, is what protects us, the average citizen, not just from the Federal Reserve, but from the politicians. It's the exact same way, or the exact same reason the Constitution was set up. It's to protect us from them, not to protect us from each other.
And that's sort of the big motivation that you have as well, is that, hey, the Federal Reserve is actually making it harder for the normal person to get ahead because they have to YOLO the options. They have to go put 0% down on real estate. They've got to get in on margin debt on stocks just to be able to get ahead.
That's
because
correct.
of all the distortions that exist.
That's correct. And then the Fed creates that boom and bust cycle. They make it they exacerbate the boom and bust cycle. And we know the retail investor usually gets in right at the end, the poor and the middle class, the unsophisticated investors. And then they're the ones that get left holding the bag. I mean, we saw this happen perfectly in 2004 to 2009 or 10, when everyone, they got pushed into, and I'm not taking the blame off those people who bought houses that they knew they couldn't afford. There's a lot of blame to go around, but they couldn't have done that without the reduction in the lending standards that was brought on by the government, and without the Fed keeping interest rates artificially low. So what happens is they're forced to go out there through inflation. Then they have to go out and speculate. They're incentivized to speculate. They're incentivized to buy that house right at the top, and then everything comes crashing down, and the banksters and Wall Street get a bailout. Meanwhile, the average Joe has to file bankruptcy, and any equity that he had, any down payment that he put into the house, his life savings, poof, it's now gone. So see, that's another way that the Fed makes it so much harder and really hurts and crushes the opportunities of the poor and middle class. It's not just by devaluing their purchasing power over time. It's by forcing them out the risk curve and then creating that boom and bust cycle that once you're out that risk curve is going to create an environment where you get crushed almost every single time.
Wow. Right. It's basically setting you up to take on so much debt at high valuations, basically leading you to have no option but to fail, basically.
Yeah. And then it's another wealth transfer from the poor and middle class to the rich. Because then what happens, the Fed comes in, they try to increase asset bubbles again. They blow another bubble. Then the poor and middle class got wiped out by the last bust cycle. So they don't have a penny to their name to go back and ride that wave up. Where who does? It's guys like me who in 2012 are going in there and buying houses hand over fist.
Yeah.
I'm buying houses hand over fist because I retired in 2012 and I had the money, I had the savings to do that. And therefore, this past, what has it been? Call it 10 years. I've had all these houses that have tripled in price, while now the poor, most of the kids your age can't afford to participate in the asset appreciation, and it goes back to the Fed. And then the people who are older, the baby boomers or the Gen X people that got wiped out in the housing market, they're struggling to get back. Most of them haven't been able to participate in the majority of this last boom that is even bigger than the boom we had in the mid 2000s, which was even bigger than the boom we had in the bust in .com, and it will continue to do so. These asset bubbles aren't shrinking; they're getting bigger and bigger and bigger. They're sucking more and more people into them, and when it crashes, who's it gonna hurt? It's not gonna hurt Jamie Dimon, I can assure you of that. It's going to hurt the individuals that are there that are just trying to do anything they can to get ahead. The average Joe and Jane.
It makes sense what you're saying, but then, I mean, on the other hand, though, I just have this feeling that like we're just gonna kind of keep down this path, and we could just go 40, 50 years down this path and not have any consequences of this. So just, oh, things went bad, print more money. And then things are getting better. Yay, 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 yay. Things go bad. Up, print more money. And what's to stop us from just continuously printing our way out of these problems?
Well, I think it's a question of probabilities.
Okay.
And sure, that's possible. But let's remember that probably one of the best performing stock markets, or maybe the best performing stock market in the last 10 years by a long shot, is Venezuela. Why? Because it's denominated in bolivars. So does that mean that you increased your purchasing power? No, but your stock portfolio looks great.
Yeah.
It's not denominated in dollars. It's not denominated in gold or denominated in Bitcoin, you see. So yeah, sure, they can do that, and asset prices continue to go up, but it doesn't necessarily mean that the asset prices are going up in real terms just because they're going up in nominal terms. Those are two different questions.
Does that matter? Like, I mean, couldn't I, if my house, goes from $700,000 to $800,000, I mean, wouldn't I be able to sell it for, the equivalent amount of Bitcoin? Couldn't I just sell it anything? I mean, it's an asset. It's a preservation of value in some sense, right?
Well, not if the price of goods and services are going up at a higher rate. So let's say you've got a house that's $100,000. You buy it for $100,000, and next year it appreciates in nominal terms by 10%. So it goes up to $110,000. Well, let's say that the price of goods and services, the stuff you buy daily, went up by 20%. Well, you lost purchasing power even though the nominal price of your house went up. That's why when I go back and look at housing prices going back to 1900, I always do it adjusted for inflation. And I've always said that at some point in time, we're going to have to come back down to our historic trend line that we were at all the way through that 100-year period. And by the way, which we bottomed out on in 2012. The bottom in August of 2012 bottomed out right on our historic trend line, going back to 1900, right? So in my opinion, we've got to get back down to that historic trend line. The question becomes,
that's like 30% now,
terms or real terms? And we could very well just go back down in real terms, and nominal prices could continue to go up forever, to your point.
Right. Because I mean, if we went down in real terms, we're talking what, 30% now?
To get back down to the historic trend line?
Yeah.
No, probably 40, 50.
40. Okay. Yeah. Jeez, that's fun. I still remember exactly where I was at the bottom of the market too in 2012.
Yeah, but it doesn't take a big dramatic event either, Kevin. If you just, because the power of compounding numbers. If we had the rate of inflation, let's say, go up by, we'll just call it 8%, and real estate prices went up by 5%. So it's just a 3% delta. If you compound that over, I'm just right at the top of my head, I'm guessing probably 15 years, 20 years, something like that, you're going to have prices of housing in real terms go down by 50%, even if there's just a 3% delta compounded. So it's not like we have to have the bottom fall out of the market in order for us to get back to that historic trend line. So we don't have to have something dramatic. In fact, people might not even realize it because it's so subtle. And it's just like, that's why inflation itself is so insidious. That's why it's a hidden tax that Milton Friedman always said, because people don't see the fact that the government is taxing them, that people don't see the loss of purchasing power. They're not writing a check to the government every year for that percentage of their income that they're losing to inflation.
Sure. I mean, it's like the famous example. Would you rather have a $2, what was it? Would you rather have a $1 pay increase, but let's say you make $100? Would you rather make $101 the next year, but there's a 2% inflation, so your purchasing power went down 1%? Or would you rather have, $99, so lose $1 of income, but we have 2% deflation?
There you
So
go.
you have an increase of $1 purchasing power.
Right.
Nobody wants that haircut on how much they're making. Everybody's going for that price increase, even though they just lost purchasing power. So it's
Right.
just the psychology of inflation there, huh?
Yep. Yep. You
Yeah.
got it.
So I mean, like, but that's the crazy thing though, is even with all of this money printing, the Fed can't get it up to 2%. You know,
Yeah, right.
they can't get it where it needs to go. So if they can't get it over there, well, like, inflation must not be a problem. I mean, convince me otherwise. Like, if they're trying to create inflation and they can't do it,
Yeah.
why are we so worried about inflation?
Well, this is a great point, Kevin. It gets into the dynamics of we'll call it quote unquote money printing, because that term is used so loosely and
Sure.
it's almost lost meaning. But let's think about what the Fed did going back to the GFC. So, and what most people would consider money printing. What they did is quantitative easing, which essentially is where the Fed creates bank reserves. That's the money they are printing, are these bank reserves. And they buy assets held by the commercial banking system. So they buy treasuries, they buy mortgage-backed securities, and they replace them with these bank reserves that didn't exist before. They're just there's digits in a computer
Spreadsheet. Yeah.
Yeah. So it's just really an asset swap. So the Fed can print, let's say, I don't know, their balance sheet prior to the what we're dealing with here is about 4.5 trillion or so, and it started prior GFC about 800 billion. So let's just say that they printed $4 trillion worth of these bank reserves. Yeah. But it really doesn't get into the real economy. It's kind of in the financial economy. The amount of currency units in the real economy, M2 money supply as an example, did not go up at the same rate. Why? Because there's a transfer mechanism, usually, of the banking system. The banking system is what creates additional money supply in the real economy by creating new loans. Because when a bank gives you, Kevin, a loan for $1 million to buy a new rental property, that's $1 million that did not exist before.
Right.
Because all a dollar is an electronic liability of the bank. It's your deposit, it's your asset, but it's a liability of the bank. They're just saying, hey, Kevin, we owe you $1 million of these dollars. And and then you take that liability that was just created of the bank system, you transfer it to someone else to get that house, and then you have the loan, right? So that's the bank. It's an example of the bank creating an additional $1 million of M2 money supply. But that happened in a completely separate environment or for different reasons than the Fed just buying $1 million worth of treasuries and doing quantitative easing. So it doesn't, there's really not a transfer mechanism unless the banking system gets aggressive. Now things have changed. And how have they changed? Because the government is coming in. Last year they ran, let's call it a $5 trillion deficit. Well, there's a couple different ways to pay for that. You know that they take those newly created treasuries and they auction them off. Well, if you, Kevin, buy $1 million worth of treasuries, they'll take that $1 million, the government, they'll take it from you, and then they'll just write $1 million check to spend it. Okay, but so they've decreased the money supply initially by taking that $1 million out of your checking account, but then they increased it by the same $1 million when they go ahead and spend it and give it to someone to build a road or something like that. So it's
government contract or whatever.
Right. It's a net wash with the M2 money supply. But now what's happening is the individuals and entities in the real economy really aren't buying the treasuries. Well, who's buying them? The Fed. So what's the Fed buying them with? They're buying them with these newly created bank reserves. So since they're not pulling the money out of the system to begin with, all they're doing is spending the money back into the system. Now those dollars that the government is spending is increasing the money supply. And that's why you saw M2 money supply go up by 25% in 2020. So the money printing that we had was just the Fed creating these bank reserves and an asset swap with the commercial banking system that really didn't translate into more currency units chasing goods and services in the real economy. Now it's different in the fact that the government is creating additional money supply by spending it, effectively spending it into existence, which we're seeing a huge increase in the currency units that are out there chasing a fewer amount of goods and services, because we've seen the supply of stuff go down so much because the employment rate has gone up. So that's the big difference there.
Got it. So really allowing this money to flow more directly in, because and this is also done in part by the Fed basically just going in their spreadsheet saying, okay, we now have more money out of thin air, and then now we're going to go buy mortgage-backed securities, for example, by a number of $40 billion a month, right? So they're basically buying them up from whoever's selling the mortgage-backed securities, allowing those people to have that cash is what you're describing.
Well, they would allow that bank to have the bank reserve. So it'd be the bank would trade their mortgage-backed securities, let's say, for bank reserves. But if the bank doesn't go out and create any more lending, then it really doesn't affect inflation, deflation, because that newly created money, if you want to look at it that way, isn't getting into the system. It would only be getting into the system if it created more loans, right? But now it's different in the sense that the banks aren't having to lend to create new money supply. The government is creating new money supply by spending it into existence, because they're not extracting it first, because the Fed is buying those treasuries instead of an entity or individual in the real economy. See, normally if the Fed wasn't monetizing the debt, then that you would buy that treasury or those treasuries, and they would take $1 million out of M2 money supply and then spend it back in. Now all they're doing is spending it back in.
And that's because of the deficit spending, the stimulus programs, and so on.
Correct.
Gotcha.
And monetizing the debt by buying those treasuries.
I see. Okay. So now this is obviously still not creating inflation, though, even though we're pouring money directly in the market. Why? So now we literally have, as you've described, the Fed pouring money into the markets directly via the government coming up with a reason to do it. Monthly child tax credit, unemployment boost, PPP. These are all things that did not really exist. I mean, the unemployment boost the last time was like $25. Now it's $300 to $600. A monthly child tax credit. I mean, they're coming up with reasons to shower people with money, right? Right. So where's the inflation?
Well, velocity.
Yeah.
I mean, two things there. I think number one, I think the inflation is a lot higher than the latest print was like 1.7 that they'd admit to the CPI. I think you ask anyone on this live stream if they've noticed the prices going up, such as food, restaurants, they'd say, oh, absolutely. Or their education costs, cars, vehicles, whatever. A few things, the prices have gone down, like clothing and whatnot. But overall, the stuff that people buy on a daily basis, I'd say most of the people would say, yeah, Kevin, they're going up a hell of a lot more than 1% or 1.7%, let's call it. So that would be the first thing. But then it goes back to what you're talking about with velocity, and that we're creating all these additional currency units at some point in time, unless Americans turn into, unless our culture completely changes to where we go into a more savings type of mentality forever. But assuming we get back to that point where Americans like to consume, which I think is most probable, then if you've got all of these currency units just sitting there waiting to be spent, at some point in time, they're going to be spent, and they're going to draw down that savings that we've seen increase. That increases velocity, and that's where you get even price increases even higher than what we've seen, let's say in 2020, 2021. And also too, you get commodity prices going up. Oil's at 60. And if oil gets up to 100, up to 150, then that's going to have kind of a trickle through effect into the economy. We've seen lumber go up, quadruple in price. So we're starting to see the signs of right now. And the Fed, unfortunately, the government, they're sowing the seeds of what could be a 1970s type of inflation, 3 years, 5 years down the line. Remember, in Weimar Germany, they started sowing the seeds of their hyperinflation in 1914. And they didn't see the hyperinflation until 8-9 years later.
I was only told the Titanic happened then, but or was that 12? I can't remember. Wow. But so I want to hit those things that you just mentioned, though. Isn't it possible, though, that these lumber prices going up, these oil issues, isn't a lot of this because of temporary supply chain issues? I mean, we have a completely different economy now. More people are working from home. You've got housing prices that have skyrocketed, which, don't get me wrong, there is asset price inflation, but asset price inflation is not consumer price inflation, right? So we've got temporary issues creating certain price increases in certain areas, but capitalism tells us that those supply chain issues will all resolve themselves. If prices of lumber are going to be high, well, we're going to have more forestry businesses that'll provide more lumber for us. Cost of chips is going up. No problem. All of a sudden, we're going to have 5 more chip manufacturers pop up because it's that much more profitable to do it. And then the prices will go back to equilibrium. Yeah,
they always say the cure for high prices are high prices. and the cure for low prices are low prices, to your point.
That's a good one.
And,
So tell me about that.
I mean, totally agree. A lot of what we're seeing could be supply chain disruption. And if we, excuse me, the free market would bring prices back down. My concern is regulation and taxes and a variety of other things that make it a lot harder and disincentivize the entrepreneur to go out there and create more lumber or fix a supply chain. So there's a few things that have to happen. It's not just that the economy, we need to get back, we need to open up again. People need to have spending money. That's true. That's the demand side of the equation. Okay, we get that. But the supply side of the equation is, in order to do that, it requires human beings, individuals, entrepreneurs, men and women out there taking risk, working their tail off, working 80 hours a week, creating new lumber companies or creating new XYZ service. And if what you're doing is creating extra demand by what the government's doing, but at the same time, you're destroying future supply, not only by the distortions, but by incentivizing or by de-incentivizing people to go out there and take risk, then you've got a very bad situation where that most likely won't come back online. So as an example, if you were someone that was, or Kenny McElroy, we're a good buddy, Ken. And, he's building apartment complexes in Texas right now, a variety of other places. But if you said, hey, Ken, you want to build an apartment complex in California? He'd say, nah, not going to happen. Well, why not? Because the regulation, the red tape, the bureaucracy, the tax, it's just not worth it. It's too much of a hassle to do that. And so that's just one little example there. But if we continue to increase regulations, if we continue to increase taxes, they're talking about a wealth tax as an example. They're talking about increasing the income tax and increasing corporate taxes and doing all these things that, the increase in corporate taxes, that gets really crazy too when you start thinking about the SLR debacle that we've been talking about. But aside from that, the bottom line is I always like to take things to an extreme to be able to think through them well. So if we increase taxes up to 100%, how many entrepreneurs would be out there creating goods and services? None. Zero, because you're working for the government, right? And then if you took taxes all the way down to 0%, then you'd have a lot more. So it's kind of a line in the sand there. Where is that line in the sand? Well, we know that every percentage point that we get closer to 100, to some degree, is going to mean less entrepreneurs out there creating stuff. So that's my concern with that, is that we can't just assume that these Keynesian animal spirits are going to kick in once things go back to normal if, and this is a big if the government continues to increase regulations, taxes, make it harder for entrepreneurs to go out there and do what they do well.
Yeah, I mean, that's a really good point. I mean, do I actually think that I can create a lumber mill in California?
Yeah.
It ain't gonna happen.
Yeah, you'd be like, hell no, I'm not. There's no way I'm doing that. Or just think of. I mean, look at what you talk about Tesla all the time. Look at what I mean. Isn't Elon Musk moving a lot of the operations over to Texas?
Oh, he's certainly starting new operations in Texas, but I mean, you can't blame him. I mean, even just getting through the building permit process out here in like Santa Barbara, for example.
Oh yeah.
Like, you got to be kidding me if you want to put anybody through this again. Like, this is stupid. You're going through it right now.
So you just don't ridiculous. Have any motivation to do
Zero.
What you did in the past. Yeah, and I was the same way. You know, I built a new home as an investment property in Portland, Oregon, back in 2013, 14. And I mean, we could sit here for the next hour and I could give you a list of all the hoops that I had to jump through, the red tape, the bureaucracy. It was insane. It took me a year just to go through all the red tape to even start clearing out the lot from all the debris and the brush. I mean, it was craziness. If anyone on your live stream right now, I mean, if anyone wants an example of why bigger government and central planning is bad, just go to Portland, Oregon and try to build a house from scratch. It won't take you long to figure it out. But my point is, you know, I was going to continue to invest in Portland and to just parlay that money into more and more projects. But after that experience, I was like, absolutely not. I am taking my capital. I am going somewhere else because I am not going to deal with this. So we're talking about how that works at a city level, at a state level. But I'm talking about if we see that also at a federal level, then you're going to have those same negative unintended consequences right at the time when we really need the animal spirits to kick in.
But Joe Biden says all the money he's spending is an investment. How is all this money not going to be an investment?
Yeah, so he's talking about infrastructure, and that's always kind of the holy grail for politicians. They say all we need to do is spend money on infrastructure and everything's going to be fine. It's just going to be this economic boom because there's a multiplier effect and yada, yada, yada. It's total nonsense. And here's why. First and foremost, exactly what we're talking about. If you build a highway to wherever, then in order for there to be a multiplier effect, the entrepreneurs have to come in and build stuff on that highway. They have to build a community at the end of the highway. They have to build gas stations. They have to do all these things. If you just build a highway, all you're doing is just paying people to dig a hole and fill it back in. That doesn't have any type of multiplier effect. So it goes back to those regulations. If the regulations and taxes are too burdensome, then it doesn't matter how much infrastructure you spend. It's not going to make any difference. It's just going to be a boondoggle that just is the Cantillon effect with all these politicians and financial insiders lining their pockets while the average Joe and Jane have to pay for it over the long run. I can give you another example too. When I was in Ecuador, there was a politician down there that built a highway from Guayaquil, which is one of their major cities, out to the coast. And this was going to be huge because prior to that, it took about 8 hours. Now it drops it down to like 2 hours to get to Guayaquil over to this coastal area. So this was going to be great for the economy. It's the same thing as this infrastructure spending. And it is true. If he would have done that, because there was no highways that existed at the time, if he would have dropped regulations or at least just kept them the same. But what did he do? He is very socialist leaning. He set up capital controls. He increased taxes. He did all these things. So the entrepreneurs in the foreign direct investment never came into the country. And the only thing that happened is some people speculated on some assets, some land and real estate at the end of the highway, but nothing ever materialized. And that was a country that actually needed the infrastructure. When you look at the United States, you know darn well that we've got I-10 probably going to right near where you live. You could hop on I-10 and go all the way to Florida and never get off that highway. I mean, that is awesome. That is fantastic for economic output. But if we built another I-10 right next to the one we have, is that going to create any more long-term jobs? No, we've already got the infrastructure. If we just fill in potholes here and there, yeah, it's great. Okay. but it really doesn't have a multiplier effect because we're a first world country and we've got this infrastructure already set in place. We're not going to have a huge economic boom from creating another bridge. When was the last time, Kevin, you got to a river and the road just stopped and there was no bridge going over it? You said, damn it, now I've got to find a way to go back where I came from and fly over this river because the road just dead ends right here. It doesn't happen. We've already got all these bridges, and sure, if we have a couple more, that might be okay. But my point is, it's because we're a first world country, we have a first world infrastructure. The multiplier effect on the dollars spent on more infrastructure isn't going to be near what it would be in like a developing country where they don't have the highway to begin with.
So I want to elaborate on this because I think what you're saying is very similar to what in Florida we used to call the hurricane economics argument, which was people would say, oh, a hurricane came and destroyed a bunch of stuff. And then there would always be this group of people that are like, that's great for the economy. People got to go rebuild houses now and windows and stuff. It's like, well, not really, because that's money that could have been spent on something productive rather than just fixing something that got broken. Is that kind of the same thing you're explaining here?
To a certain degree. I mean, that's what we call the broken window fallacy. Where they'd argue that if a little kid went by a store like a bakery and just threw a rock through the window, that would be fantastic for the economy, because then that store owner would have to take savings and go fix that window, which creates jobs and creates economic output. And of course, to your point, what they forget to mention is that store owner would have taken that $1,000 and used it to grow their business and to create more goods and services. And now they're just getting back up to where they were. So yeah, in a way that I think that infrastructure spending, when you look at the United States specifically, is that same thing that, yeah, we can go out there and fill in some potholes, and which might be needed. I'm not saying it's not needed, but I'm just saying it's not going to create this huge multiplier effect because we're just getting right back up to where we were.
So we're just going around fixing the broken windows with the money that we got from taxation, but we're really not progressing. We're not getting to the next level. It's not like all of a sudden we can drive 200 miles on these highways. We're still stuck going 65.
Yeah, and it's not like these highways it's not like we have all of these areas that if only we could build a highway to this, XYZ field in the middle of Nebraska, oh my gosh, it'd be an economic boom. No, all those highways already exist. Let me give you another example. I spent a lot of time in Colombia, and the two major cities there are Bogota and Medellin. So right now there is no highway, believe it or not, going between these two major cities. One of them, Bogota, has like 12 million people. Medellin has about 4 or 5 million. So it's not like they're these little fishing villages or anything. And you just have to go through this mountain road. It takes you like 12 hours to get from one to the other. Now, if they had a highway like I-5 or I-10, I don't know what it would be exactly, but my goodness, it would drop that down to like, let's say 2 hours. And then think about how much more efficiently goods could go back and forth and how much time that would save and how much more productive every single one of those individuals and entities on that supply chain would be. How many more goods and services that creates economic output, additional economic output. And that is definitely where I would agree with the politicians that say that that infrastructure spending would have a great multiplier effect. But unfortunately, that's not the type of infrastructure spending that Joe Biden is talking about.
I mean, it really creating that kind of highway would be, in some sense, innovative, because you'd be providing almost a style of service that hasn't existed before. Very fast transit.
Yeah, we already have those highways. That's the thing.
Right.
Now, if you could somehow say that we were going to improve I-10, and then that would allow us to increase the speed limit to 150 miles per hour. Yeah, right. I mean, there might be an argument for that, but I don't think that's what they're talking about. Maybe they are.
No, yeah. So there's this question that came up here. Somebody asked, hey, they're going back to this argument that you made about the job, the person at McDonald's. So the person's working at McDonald's. If there's deflation, he actually becomes or his purchasing power increases over time, which is great for him. The argument that the person in the question here has is, well, I mean, look, if prices are going down via deflation, why keep paying the worker $1,500? Just drop their wages.
Well, I just point out what the actual numbers were in the late 1800s. Nominal wages went up by 1% per year.
Okay, so you're looking at the 1800s and saying we had deflation in prices in the late 1800s, but wages went up. So why can't we go back to that?
Correct. And so why are wages going up? Because people are able to save money. And entrepreneur, we have sound money. We have very little regulation. Let's remember, government is, let's call it 3% of GDP. In other words, the private sector is 97% of GDP. And then you have entrepreneurs going out there competing with one another. And let's think through how we get price deflation. Well, we get price deflation by increases in technology, and then entrepreneurs going out there and creating more goods and services efficiently and with increasing efficiencies, right? Well, how do they do that? They need people. They need employees. They need workers to do that. Well, that creates the more goods and services that are being produced ever efficiently, creates more demand for workers. Therefore, they've got the leverage. Therefore, you've got, that's most likely why you see the wages in nominal terms go up in the 1800s or late 1800s, while at the same time, the cost of goods and services were going down.
That's interesting because they're growing and they want to grow faster. But today you also have this question of automation. I mean, the faster we grow, the faster we deflate in terms of technological costs. In theory, the less desirable it actually is to have workers.
Well, see, here's my pushback there. This is not the first time that we've seen a technological advancement, and to the degree of automation and self-driving. And that argument assumes that people's wants are stagnant. Okay. So you have, let's say you want X, Y, and Z, and you get your need, you get your wants fulfilled, and therefore you don't ever want anything else. I don't believe that. I think if you look through history, it tells us quite the opposite, that the wants of the human race are unlimited. And there's a lot of things that we want now that people 20, 30 years ago couldn't even fathom would exist. Wow. Right? And it's, in my opinion, it's the exact same thing. I think history would agree that if you have, let's say, self-driving trucks or self-driving cars, something like that, that would put a lot of people out of work. It is true that those people would be out of work, and that would be a negative for those people. But on net balance, those entrepreneurs would go out there and they would figure out new things that people want that we can't even imagine today, that those self-driving cars are allowing us to produce. And therefore being created, and then you have more jobs being created over here that we would not have had. So it's a push and pull, and that goes back to Schumpeter's creative destruction and the value of creative destruction in a free market economy.
Yeah, I mean, in theory, you could have virtual reality headsets and then develop an app store for those while you're in your self-driving car, so you could be entertained in your self-driving car and employ people that way. Just going.
Yeah, I mean, when I was growing up, I grew up I was born in 1973, and when I was, a kid in the early 1980s and stuff, I mean, you said, hey, George, one day people are going to be walking around with a phone like right in their back pocket. I said, what are you talking about, man? What are you saying? Right. I mean, no one could have really, pagers were like a big deal, for heaven's sakes. They're like, oh my gosh, you've got a pager. Whoa, that's cool, man. And, no one could have envisioned an iPhone back then with all these apps other than maybe Steve Jobs. So, but now we've got an iPhone, now we've got Android, now we've got all these other things. Now we've got TikTok, now we've got Instagram, now we've got YouTube. And no one could have fathomed these things back, let's call it 30 or 40 years ago. Now we have them, and now they're new economies that are being built on these ecosystems that have been produced through this technology that most likely have destroyed some jobs. So again, it's that. But see what's really key there, Kevin, is that you allow the economy to have that dynamism. If you burden the economy and the entrepreneurs with regulations and taxes, the economy isn't going to be able to shift as efficiently as it otherwise would. So I mean, I'm someone that says, okay, just let the free market work. If that means we have self-driving cars, so be it. But at the same time, we've got to make sure that the regulatory environment isn't stifling. Therefore, people like whomever your favorite entrepreneur is, say Elon Musk, can go out there and create new industries to build new jobs that we can't even imagine right now. And if you sit there and you burden people like that with all these regulations to where they can't build these things as fast as they otherwise would, then society just doesn't benefit. And at the end of the day, I'm a firm believer that society is really pushed forward by maybe 1% of the people out there. And I'm not saying that these people are any better or even wealthier. It's just that you got this hardwiring in some people. I would put you into that category where you just work nonstop. I mean, you're working 80 hours a week, for heaven's sake. You're producing. I mean, you produce way more than you consume, and you save the rest, and you're creating opportunities for your editors and all these other things. And I can't even imagine how many people you employ with your real estate business. I think your wife has a property management business. That's all a result of you going out there and kicking ass when you don't have to. But not everyone is hardwired that way. So it's people, the entrepreneur that really pushes society forward, like let's say Elon Musk, if you want to use him as an example. So again, the government needs to support these people. We don't want to demonize them, and we want to create an environment where they can maximize on their full potential, and society can benefit from that.
Right. So what happened in Japan then? Why is there this lack of what people are calling now this lack of creativity and entrepreneurism or whatever in Japan, and now they're suffering from deflation rather than inflation, despite all this debt and government output?
Exactly what we're talking about, because they didn't allow Schumpeter's creative destruction. What they did is
too much regulation. Is that what you're saying?
Well, no, they propped up all they didn't let anyone go out of business. Exact same thing we're doing now. They said, oh, no, we can't have the corporations go out of business. Oh, no, we can't have the banks go out of business. Oh, no, we can't have that. We can't have that. We got to prop everyone else. So we'll just print up all this money and we'll bail everyone out. And then we'll just continue to create these zombie companies. You know, Radio Shack is a great example of that. Look at how long it took Radio Shack to go out of business, or any of these things. I mean, go down to your local strip mall. Do you think that any of those businesses should actually be in business or would be in business if not for the government? Absolutely not. And if the government just let Circuit City or Best Buy or whatever go out of business, then that would open up, and then people who are more prudent would take over those assets and maybe change it into something that is very productive. GameStop, for heaven's sakes, let's use that as an example. Right? If the government comes in and supports GameStop, and I'm not saying they are, but if they did, maybe that would reduce the probability of people coming in and changing GameStop and being able to take it over from because the stock was, I don't know where it is now, but it was so cheap. But you had the guy that went in there on the board, right? I think the guy was I forgot his name.
Co-founder, Ryan Cohen.
Yeah, so he went in because he saw potential in the brand. But not with the same business model, with a completely different business model, you see. But if the government would have come in and propped them up, and their share price never would have got below, let's say, 100, well, then that gentleman, that entrepreneur, would not have had the opportunity to come in and do what he's doing to potentially change the business, turn it around, and make it something that's sustainable and viable over the long term. That's a perfect example.
I was going to ask you, like, what stopped, GameStop existing, or Best Buy or Circuit City or Radio Shack taking forever to go away? Didn't stop Amazon from coming around.
yeah, it didn't stop them, but think of all the Amazons we don't have.
Oh, well,
You see, it goes back to Hazlitt, and it's not just the seen, but the unseen. So you look at Japan and you say, well, they didn't do too bad. They've had a little bit of deflation, but but we don't see the Japan that would have been if they would have just let those asset bubbles deflate, like we did in the early 1920s. Back in 1990, they would have gone through the pain. Absolutely. They hit the end of the musical chairs game. So they got to take the pain, but then they build on a stronger platform, and who knows what Japan would be today.
Wow, that's incredible. So where do you think China fits in on this? Because right now, arguably, everything in the world is contracting with the exception of China and the US.
Well, I would argue that the United States is contracting as well. If you're talking about economic output, GDP is a function again of the government spending. So I don't know if I would consider that true economic growth. But as far as that's a whole different can of worms. I think what's interesting about China right now is their implementation of their central bank digital currency, and talking about infrastructure. Over the last 10 years, they've been doing this Belt and Road initiative, where they've got all these huge infrastructure projects with all these areas around India going into Eastern Europe, and then I believe through the railway that goes through Russia, and then down into Africa. They've also had a lot of investment into South America as well. And how does that work when they're rolling out their digital currency? And is this Belt and Road initiative a network system that they have created in order to roll out this adoption of their central bank digital currency to potentially compete longer term with the dollar? And when I mean longer term, I'm not talking about a year or 3 years. I'm talking about 10 years, 20 years, 50 years type thing. That's what really interests me about what's going on with China and the whole region right now compared to the dollar. And I think that's when you include the topic of Bitcoin as well, because I think that they're just all competing networks, and it'll be really fascinating to see which network wins.
Yeah, well, so here's an interesting question for you on that. I'm excited to hear your thoughts on this. So the other day, I was thinking about how it's possible for like all these websites like a BlockFi or whatever to pay people interest on stable coins. And so I have this belief or concern that in theory, if there's $100 million of like a Gemini stable coin pegged to the dollar, but then I deposit money with, let's say, BlockFi. I agree to lend that money out. BlockFi lends that money to another company, and then that other company's like, let's lend this to somebody else. And we've got this rehypothecation going on over and over and over again in the stable coins. Isn't that potentially a danger? Now you're shaking your head. No, you tell me what's going on.
No. I'm agreeing with you. 100%. What a lot of people are doing are taking something like Bitcoin that's deflationary money. Yeah. And they're turning it into what we don't want, which is inflationary money by lending. And I'm not saying everyone's doing that, but there's some people that are arguing for that. I mean, what's the problem right now is that the financial economy is way too big in comparison to the real economy. I mean, you would think that it would be the opposite, as it should. The real economy is what should support just the little financial economy that just gives people an opportunity to participate in the equity position in something that actually produces goods and services, right? Yeah. But now we've got $2 quadrillion worth of derivatives, $2 quadrillion. So, and that's just people, these banksters just betting on whether this will default, credit default swaps, CLOs, all the stuff that you heard about in the GFC. Well, all of that has gotten a lot worse as far as them creating these financial instruments to try to somehow capture yield and alpha above the market. But again, why are they doing that, right? Would they be doing that if the Fed wouldn't have dropped interest rates to 0%? Would they be doing that if they could get a 7% return on a treasury yield? Probably not, because they're getting these capital flows from the pension funds that have that 7% bogey. That's what they have to meet in order to meet their liabilities. And if 10-year treasury is trading at 7%, well, that's not too hard for those pension funds. But if it's trading at 100 basis points, now they got a big problem, especially if that happens over the course of, let's say, 10, 12 years. So then they force all of this money and liquidity into these hedge funds and into these banks and investment banks and whatnot, and they come up with all
figure it out.
creative financial instruments to try to get yield. Well, that's one of the problems here. That's one of the reasons why our economy and the global financial monetary system is so fragile. And that goes back to what we saw in the GFC, and it's only worse now. So why do we want to take something like Bitcoin, which is supposed to be the way out of this problem, and just turn it into something that looks exactly like the problem we already have? And I completely agree. I don't like any type of rehypothecation. Just because it's a cryptocurrency that's being rehypothecated, I don't think that's any better.
Yeah, because I mean, in theory, you could rehypothecate 2 times, 3 times, 100 times. Nobody would know any better until, of course, there's a crash.
Yeah, and that's exactly what they're doing right now with treasuries. And it's exactly what this gentleman on the Reddit forum was referring to in his argument. What does he call it? The biggest short in history.
Everything short.
Yeah, that gets to what he's referring at the end when he's talking about the repo market.
Let's talk about this. So there's this guy on Reddit, got pretty popular, at least from this post here. Let me put myself over here. So basically makes this argument, pretty long argument here, that Citadel and some of these basically hedge funds and market makers are basically have so much power in the repo market that essentially there could in the future be a potential short squeeze. And I'm just really like too long, didn't read summarizing here. There could be a short squeeze on bonds, and he's got this really long piece on this.
Yeah, you want me to summarize
I want you to
it?
maybe you explain it. Yeah.
Yeah, I can summarize it. So what happens is so the repo market, just to start, is a marketplace that's really the lifeblood of the global monetary system. Okay. And so if a bank or a hedge fund, they need liquidity, they can go into the repo market. And basically what that's saying is, hey, listen, we need cash overnight. We don't have any cash, but we do have these treasuries on our balance sheet. So we'll go ahead and give you these treasuries as collateral. You give us the cash and we'll swap back the next day. Technically, it's a sale. That's why it's called a repo transaction. So you've got a repo and then a reverse repo.
Just for the 5-year-old in me. So here's my treasury, and here's someone with a sack of money.
There you go.
And so who's who?
So the person that is taking the money, that on their balance sheet, that would be a repo transaction, because it's a repurchase agreement. So they're agreeing to buy these treasuries back either tomorrow or in 2 weeks, something like that. So for the person giving
party
them,
A is going to take some money.
That's right. So that's a repo transaction on their balance sheet.
Party B is getting some collateral here, this treasury bond.
Right. So that's a reverse repo, which I shouldn't get into the technical terms because it doesn't really matter. But what's happening right now is usually, I'm sitting here pointing at the screen like your audience can see that. What's happening is obviously they would charge an interest rate for the money, like let's say 1 or 2%, something like that. But if you notice in what you're drawing there, that one entity is getting cash, but the other is getting a treasury as collateral. So
what over here they're getting cash. They're getting dollars, and they're over here. They're getting basically a little bond here.
You got it. So what this gentleman pointed out on the Reddit thread is that some repo rates recently have gone negative. So what that means is your entity A right there or excuse me, your entity B with the cash to begin with, is paying entity A to take the cash in the first place. Well,
Wait,
why
so
on earth?
negative means
so
these people have cash and they're paying these people to
To
hold their
take-
cash. Why would they do that?
they're paying him to borrow it, because the reason they're doing that is because they want the treasury.
They must want the treasury.
There you go, bingo. They want it.
Okay,
so why do they want that treasury? So they can sell it short into the treasury market and bet that interest rates are going higher. In other words, bond prices are going lower.
So these guys, they want the treasuries simply to short them, is what you're saying.
Correct.
And they're shorting these treasuries because when you short the treasury, what you're saying is they think the price is going to go down. That's the bet. So the bet they're making is that price goes down and yield keeps going up.
Correct.
Which is kind of a very Ray Dalio, like stay away from bonds right now. Yields are going to go up, prices going down. So now you've got these hedgies who are like, oh, I got a brilliant idea. I'll just short and take advantage of that and make some money over here. So I'll pay some nominal interest over here, which will look distorted, but who cares? Because I'll still win because I'm shorting a market that has no way but down.
You nailed it. You nailed it.
Okay.
And especially when the Fed comes out, when Jerome Powell comes out and says, well, we're just going to let inflation run hot. And all the reporters say, well, my goodness, are you going to do yield curve control? Are you going to buy the long
Nope.
to make sure that rates don't go? Nope. We're just going to watch it. We're not going to do anything. So then all of these hedge funds and banks, to your point, like, okay, well, if Powell isn't going to intervene, and we think that we're going to see higher rates of inflation. If he's going to let inflation run hot, then that's going to mean the long end of the curve most likely is going to go up as far as interest rates. That means prices going down. Let's short it. Oh, shoot.
Right.
There's not enough treasuries to short. I don't have the treasuries. Do you have the treasuries? No. Let's go into the repo market, and that's where we can get the treasuries. And so they're like, oh, shoot, how do we get the treasuries? No one really wants to lend them. Well, we'll pay for them. How do you do that? You pay people to take the loan in the first place, which in essence, to your point, is paying people for the collateral to short.
So, okay, so now they short, and this individual here on Reddit makes this argument that this is setting up for a giant short squeeze, and that now because there's a short squeeze, or potentially, and we all know that with short squeezes, thanks to GameStop, short squeeze means big tendies. This person's suggesting we should all go buy treasury bonds?
I don't. He doesn't say that explicitly. I think that's what he's alluding to, because and I highlighted it here, Kevin, because he's using some terminology that I'm sure you're more familiar with than I am. So and I'll read this to you guys because maybe I'm wrong here. So he's like, their high frequency trading systems allow them to manipulate the market in their favor. So there's no way they could fail. He's talking about the bank shorting treasuries, unless a bunch of degenerates all decided to ignore taking profits, but that would never happen, right? Wrong. We just like the stonks, diamond effing hands. So I'm assuming that's what he's saying. Is he's saying, hey, listen, there's this huge short squeeze opportunity because there's no treasuries, there's not enough treasuries, and they're shorting more treasuries than are available. And the proof is because they're going into the repo market and they're trading at negative interest. They're giving cash at negative interest rates. They're paying people to take money. Therefore, there must be this huge short squeeze opportunity. Therefore, buy bonds on the long end of the yield curve with diamond effing hands.
And what's your conclusion on that?
My conclusion is that's probably not a great idea, because we're in an environment where if the banks are right, and if Jay Powell is not going to do anything about the long end of the yield curve, those interest rates could continue to go up, especially if we're in this money printing environment like we've been talking about throughout this live stream, and we're going to see significant inflation. That would mean most people want to sell the treasuries, therefore less demand, the price goes down, interest rates go up, and that's a very dangerous position to be in. And I would also say that throughout this article, the gentleman references the amount of daily transactions in the repo market. And I don't want to, I mean, he's done some fantastic work. So my hat's off to him. But he might have slightly miscalculated the daily amount of transactions. He kept, and I don't want to put words in his mouth here. I want to be very clear. But it kind of seemed to me when I was scanning it that he was talking about 30 to 40 billion dollars a day.
Here it is. In fact, the submitted amount for repos today, 3/29, was 40 billion. This represents the one-day repo due on 3/30.
Right. So click on that hyperlink, Kevin.
Okay.
So that goes to see how that goes to the Fed's website?
Yeah.
So what he's doing is he's looking at the amount of transactions that the Fed did, not the entire market.
This is just the New York Fed's repos, not all of the repos that happen between all the different banks.
Correct.
Oh, so that's a fraction.
Well, from the research, and I don't know if it seems in his article he's implying that that's the total amount. I could be wrong. I don't want to put words in this gentleman's mouth.
Sure.
Because, hats off to him. This is a fantastic post. And if you haven't read it, you definitely should. So I don't want to sit here and poke holes in his argument. But if from the research that I've done, the daily transaction volume in the repo market is right around 4 trillion. And that's a lot more than 40 billion. And why that makes a big difference is because if you're trying to create a short squeeze by buying something like GameStop, if the float's very small, then you can do that. You can pull it off. It's a lot harder to do it in the silver market, as an example, because it's just a lot bigger market. And it's, I can't even imagine a world where it would be possible to do it in the treasury market, where just with repo, there's $4 trillion a day going back and forth. And that doesn't include the amount of transactions with treasuries that are happening outside of repo. I mean, you're talking about, you would have to be like a central bank. I don't even know if they could move that market. That would be almost impossible.
So you're saying the reason the short squeeze was so possible at GameStop is because the market cap of GameStop, I'm pretty sure at one point fell to substantially under $1 billion. And I mean, it doesn't take a lot to move that. I mean, quite frankly, if I were to, like, you see this, even just YouTubers with smaller channels, they talk up a penny stock with like a $50 million market cap. The thing goes up 50% in a day, you know?
Exactly.
Okay.
Yeah, because
but you're talking about a $4 trillion market.
And that's just in repo. That's just in repo. So that's not going to happen. Now, I'm not saying that if you bought bonds and didn't have in diamond hands or whatever and just held on to them, that you might not make a little money. Who knows? Interest rates might go back down. There's a great argument for that. But you definitely would not be making that as a result of forcing these hedge funds to buy back their treasury positions at increasing prices. That's for sure. It
seems like there's a lot of this appetite to try to find the next big short, the next next big GME. Yeah. So, okay, well, how are you investing today then? So, you don't sound optimistic about real estate prices. You don't sound optimistic about dollar-denominated stocks. You don't sound optimistic about a lot of things here, man. What's up?
Well, the real estate is a tricky question because if you can buy real estate that's got a really good, solid, positive cash flow, and if you can do that with 30-year fixed rate debt, to me that's interesting. Because the world is so weird and distorted. I think we've gone from a point where the property is the asset on your balance sheet and the debt is the liability, and it's almost switched to where now the debt is actually the asset and the property could potentially be the liability. Because let's just assume that, you're an expert. So again, if you're an expert at something, it's a little different. But let's just say that you're the average Joe that's going to go out there and buy you're just buying off the MLS. You're not getting a wedge deal. You're not doing any of these things. You're buying retail. And you go and market like, I don't know, or something. Colorado would be a great example. It's really gone significantly because of people moving there. And you just buy right off the MLS. You buy it. Okay, great. Well,
where was that again? It cut out there for a second.
I might have said Dallas. I meant Denver, Colorado. Excuse me.
Denver. Okay.
So you've had these prices just do a moonshot, and you're buying at prices that are at all-time highs in real terms and in nominal terms, and you don't know what you're doing. You buy just off the MLS. There's no wedge deal. Then you're buying. There's a decent chance that in nominal terms the prices could go down. There's a much better chance that the nominal prices go down today than, let's say, in 2012, because then you're buying when stuff is cheap. Now you're buying when stuff is expensive. Yeah. So that's why I say now the property in that circumstance might even be considered a liability, because the probability is decent that even in nominal terms, the price could go down over the next, let's say, 5 years. But if you buy that property with 30-year fixed rate debt, and if we do get a bout of, let's say, 1970s type of inflation, then you're going to be making a lot of money in terms of purchasing power by paying back your debt with devalued dollars. Because
what deflated money.
Deflated money. There you go. See, what happens is let's say your mortgage payments are $1,000 a month. Okay. Well, if we go through hyperinflation, your mortgage payments are still $1,000 a month.
Yeah.
But yet that $1,000 a month can buy you a loaf of bread. You see? So that's a huge transfer of wealth or purchasing power from the lender to the buyer or the borrower. That's why I say that if you believe that we could see some 1970s type of inflation at some point in time over the next 30 years, then you could see how that debt, as long as you're able to service it, that's the key. Mm-hmm. You get these people that are over leveraged that can't service it if they have a renter move out, then that's not what I'm saying. But as long as there's a good chance that you can service the debt over the long term, you could be making a lot more purchasing power on the debt than you're losing by the asset, even going down slightly in nominal terms. It's like reverse, because before you would lose money on the debt because you got to pay interest, right? Yeah. But you gain money in the property because of the cash flow and or appreciation, right? But now I think it or in the future, it could be reversed. So that's something for the sophisticated or maybe more sophisticated type of investor to think through. Just because I think that housing is extremely expensive right now, and I personally wouldn't be a buyer, I don't know that there's not a way to set it up to where it could be advantageous from a risk reward standpoint. Now, with the broad S&P, I don't see how that could be a good move, at least using my playbook. And the way I like to invest is just keep it very, very simple. I don't try to figure out the direction of a price of something. I just start by asking myself if it's cheap or if it's expensive. And if it's cheap, I just try to buy it. If it's expensive, I just try to sell it. And a great example of that would be oil producers back in March of 2020. This was when oil was about maybe 25 a barrel, 20 a barrel, something like that. And I personally thought that oil was going down further in price. But I jumped in and I bought a lot of stock in certain oil producers because I was trying to abide by my own investment rules. And that's ignore price direction and just ask yourself if it's cheap. And back then, the answer was yes, it is definitely cheap. So even though I think the price is going down further, I'm still going to jump in and start buying for that reason. And it turned out to be a good thing. Because when you try to time the tops and the bottoms and figure out the price direction, I
Yeah.
just don't think anyone can do that well over a long period of time. So I try to
What do you
stick with
say?
that.
Yeah, I mean, I love that. But I mean, like anytime the market is falling, for me, my opinion is, look, when the market's going down, risk is going down with it. Like it is harder. Like it's easy for Tesla to go from 900 to 600. In my opinion, it's harder for Tesla to go from 600 to 300, right? Like that's exponentially harder than that first decline. And I know, Tesla's very expensive. It's certainly not like oil in your example here. But when these prices are coming down, it's very common for society to say, oh, you're catching a falling knife. Don't buy, falling knife. What's your reaction to that? I mean, it sounds like your thinking is just keep buying.
No, not necessarily. I'd go back to a chart and try to figure out if it's historically cheap.
Okay.
So let's go back to real estate. I bought a lot back when I retired in 2012, and it's because I looked at that chart of going back to 1900 that we've referenced quite a few times, and I saw that historically speaking, it was cheap. It was even slight in the area where I was buying. It was below its historic trend line, and then when you factor in the cash flow, I mean, my goodness, it was super cheap.
Oh
So
my gosh,
let's
you
go
can
back to
borrow
oil.
everything.
Oil is another one to easily think through. If you look at a chart of oil going back, let's say 50, 60 years, adjusted for the inflation rate that the government tells us, you'll notice that when it gets below $30 a barrel, it's almost always going back up. I mean, it's considered pretty cheap. And then when it gets above 80 or 85 a barrel, kind of expensive. It still can go up a little bit, but it's normally going to come back to kind of revert to a mean type of thing. And so, with commodities, obviously, this is a lot easier. But so that's why when oil was down at 25, I considered it quote unquote cheap, because historically speaking, adjusted for inflation, it got below that kind of $30 threshold.
I mean, could you just turn on the RSI chart then, the relative strength index, and go there, boom, oversold, overbought, and just play that on the commodities?
Well, I think that would be more trading than anything else. And when I buy something, I mean, I'm like, when I buy a stock, I'm like you with real estate. Like that is diamond hands. Like I don't plan on selling that stock, but I'm not buying a stock as I'm buying it strictly off the cash flows. I'm buying it if it's an underlying commodity on the long-term chart. I'm not buying it because it's expensive and I think it's going to get more expensive. Or I don't buy something and hold on to it for the sole purpose that I think the price is going up. That's I think what most people really get fixated on is I got to figure out if the price of this is going higher or lower. Is the S&P going higher or lower? Is Tesla stock going higher or lower? Oil higher or lower? I don't try to play that game. And I'm not saying that's wrong. I'm just saying that's not my game. I just ignore price direction and try to focus on cheap or expensive. And right now there are very few things in the United States, dollar denominated, that are cheap. That's for sure, historically speaking. So I have the flexibility of going outside of the United States and investing not only in stock markets, but real estate markets, where I would say the value proposition risk reward is superior. And I understand that most people don't have the ability to do that. But I think that brings me to the next step of the investment philosophy. And that's something I call 10-80-10 rule. So that's what I like to do to keep it very simple. So I set up 10% of my portfolio as insurance, or what I would consider insurance. For me, that's physical gold. Then 80% of the portfolio I would consider investments. So that's something, by my definition, that would pay you to own them. So like a dividend paying stock, a great rental property with awesome positive cash flow, that's paying me monthly or quarterly or whatever to actually own it. That's an investment to me. Then on the 10%, the remaining 10%, then I would get into speculations. They're not really paying me to own it, but I think that there's good asymmetry. So we talked about gold as being an example of insurance. We talked about real estate being an example, or a dividend paying stock as an example of an investment. Let's talk about speculations. Bitcoin, I think, would be a great example of a speculation. Uranium producers, gold miners maybe that aren't paying a dividend. That would be an example of something that's got quite a bit of asymmetry. But I just don't like it for the majority of my portfolio because, quite frankly, I'm not that good. So what's great about the investment side of the portfolio is you really don't have to get the price direction right in order for the asset to work in your portfolio long term. So as an example, let's say that you've got a property right now that you just paid $1 million for. It's got a decent positive cash flow, but your renter is paying the mortgage. So you're building that equity every single year. And at the end of the 30 years, your renter will have bought that property for you. And you will own whatever it is worth at the time. You'll own 100% of that. In addition to that, you're getting a monthly cash flow. You're getting paid to own it. And you don't plan on selling it. It's just like buying a McDonald's or buying a business. So do you really care if the price goes down in 5 years?
Doesn't matter.
Not really. Not really. I mean, you're an expert, so you might want to leverage the equity that you have. But that's a whole different topic of discussion. If you're just buying it for the cash flow and for the long term, you don't really care what the price does. Again, I always use the example of a McDonald's. You know, before I retired, I was an entrepreneur, and I would look at businesses that were about that price point, about $1 million, couple $1 million. And if I went in and looked at potentially buying a McDonald's franchise, I would ask for the profit and loss. I would look at I'd maybe look at their balance sheet. The balance sheet's so simple on those things. But I would just look, hey, what's coming to the bottom line? And how much do I have to spend out of pocket to get? What's my return going to be? If the broker came to me and said, well, George, I don't know. I mean, I know this McDonald's is making about $150,000 a year, and you could probably improve it a little bit. So in 5 years, it's making $250,000, and you could grow that over time. But in 3 years, because interest rates are so low right now, if interest rates go up in 3 years, the value of what you could sell this McDonald's for might go down. I say, what? Who cares? I don't care what the value of this McDonald's is going to be in 3 years. If my cash flow is growing, if I'm able to build this business, if today it's making 150 grand a year, and in 3 years it's making 250 a year, but yet the value goes down because the interest rates go up, who cares? I'm not selling it. I'm buying it for the cash flow, and I'm buying it just to give to my kids or create long-term wealth in my family. So that's how that's how I look at that 80% of the portfolio, and that's why I do such a large percentage that pays me to own it, because I don't have to get it right. I don't have to get the price direction right in order for it to make sense.
True. Now, would you be in a different situation, do you think, if you weren't retired? If you okay. How would you be investing differently?
I'd set the structure. Like if I was young, if I was your age, I wouldn't do a 10-80-10. I'd probably do like a 10. I'd probably do a 10 50-40 maybe, or I'd play around with it there. So I had a little bit more
risk.
You'd
up your spec.
Yeah.
Okay. So that way, because you got like the wind at your back, you invest in those growth companies or whatever, because you have a longer time horizon or whatever.
Yeah, I personally still wouldn't invest in growth companies, because I don't really, because to me, if you're buying growth, and again, I'm not saying that this is wrong or bad.
It's fine.
It's not my style. When you're buying a growth company, you're basically paying $3 for $1, hoping it goes to $5. And what I like to do is I just like to find $1 that's selling for 50 cents. So what that does is that if a company's not making cash, they don't have a good history of making solid cash flow, then I'm probably not interested, even though you could get a 10 bagger on it or something like that. I might put it in that 10% speculative side, but probably not. I like going in and, again, going back to real estate in 2012 or oil in 2020 March, you just those oil producers were making a lot of money. And now that's not to say they won't make money or they won't make less in the next year, because that's what everyone thought. But even if they do, they've got a long history of making just tons and tons and tons of money. And therefore, I kind of feel as though you're buying a dollar for 50 cents. You're just kind of buying it on sale. and nothing really has to happen. The company doesn't have to grow exponentially in order for you to for that investment to pan out. They just simply have to go right back to where they were. And it's same thing with the real estate. You know, nothing needs to happen to the price of real estate in order for it to make sense in 2012, as long as you're continuing to get that rent payment. And that goes back to a question of how good are you at real estate and why you should always buy, in my opinion, you should always buy in A and B neighborhoods and leave the Section 8 and the war zone to other people.
Oh, yeah. I mean, it's interesting. So really trying to get that consistent cash flow and finding that cheaper. I mean, that's really similar to buying like wedge deals, I like to say, buying real estate below market value. And that's one of the things, like I was talking to, or previously I've interviewed the CEO of Robinhood. And, he was saying, hey, look, with stocks, it's so great. You can just buy and you're done. You swipe up and you're done. There's no headache of real estate. I'm like, yeah, but in real estate, at least, comparing to growth companies, right? I can buy real estate below market value. When you buy a share, you're paying the same market price as everybody else is of like a Tesla or whatever. So I think really what you're saying there is, where can you find something that's under market value? And I think that's pretty powerful.
You find it in markets that are inefficient. So so an inefficient market is going to really benefit the person who's an expert in that market. And so when you look at a stock market, it's wildly efficient, or the gold market or Bitcoin or something like that. If gold is selling at $2,000 an ounce, you can't find someone that's going to sell it to you for $1,500. It ain't going to happen, right? It's a very efficient market. Real estate, not efficient. Real estate is a very inefficient market, and especially when you get overseas, when they don't have an MLS and you don't know what's going on, you don't know up from down. It is wildly inefficient. And
where?
Oh my gosh! If I told you some of the deals that I get in Colombia, as far as the value, the RV ratios, the cash flow, and just there's a lot of those people that I buy from in Colombia. They don't even know the value of what they have. But think about that for a moment. Let's just pretend that there was no MLS.
Okay.
And let's also pretend that there was no network of real estate agents that all like talked to each other and did all these things. And then let's say
no Zillow.
No Zillow, none of that stuff. None of it.
Okay.
Nothing on the computer at all. You just sell a house by putting a for sale sign in the window. That's it. That's your only option. To a certain degree. They've got a couple websites, but let's just say that's your only option. And let's say that you bought the house, or it's been in your family for 40 years. How would you know what the price was? Like, you bought it for $5,000.
You take phone your neighbor. Maybe like, yo, neighbor, what'd you sell your place for, right?
Yeah, you got to find one of your neighbor. And in countries like South America, they're very, or countries like Colombia, it's very similar to how the United States was back when I was growing up. That if you knew someone well, that would be an appropriate question. But if you didn't know them well, that would be a wildly inappropriate question to ask them. Oh, how much did you sell your house for? None of your business. I mean, what are you talking about? Like when I was growing up in the 70s, like that was just kind of, you just didn't really do that, and Colombia is kind of the same thing. Now, I'm not saying that they wouldn't call their neighbor or something like that, but my point is there's no flow of information. It's extremely inefficient. So I've bought properties there for literally 50 cents on the dollar that the people just needed liquidity. There's not that much debt in the market. So you have to have cash. So if it takes you a year to sell a property, but if you need the cash right now, you're going to pretty much sell at any price if someone's got the liquidity that you need. So you can go in there. Sorry?
Can you get financing out there?
No.
Yeah.
No. Well, the gringos can't. The Colombians can, some of them can, but it's like 40, 50% down. It's going to be 12, 14% interest rate. So it takes you a good year to sell a property. So if you get into a financial bind where you need to sell in like a month or two, it ain't going to happen. The buyer is basically going to name their price. And so that's what I'm talking. So that's even more inefficient than the United States, which presents a better opportunity to make money, but also a better opportunity to get screwed if you don't know what you're doing.
Well, but yeah, how do you know what you're doing in an area that you don't live in?
Well, you just have to do the boots on the ground research. I mean, one of the things that I'm going to do here in the next, well, who knows with what's going on with the everything, but minus what we've had to deal with over in 2020, 2021, I was supposed to go to Dubai because the real estate in Dubai is getting very cheap. They peaked out. Yeah, their market went down like ours did, but it went way back up to a high in 2015. And it's been going down significantly ever since, to the point, well, you've got number one, oil prices going down. You've got, I think they struggled a bit because their currency is pegged to the dollar. So you had increase in dollars, the value of the dollar, was going up. Yeah. And then they kept overbuilding because they thought that all these people would come in. They weren't coming in. And then what happened in 2019 is they knew they had a supply glut, but they created an even bigger supply glut because in 2020, they were supposed to have the World's Fair in Dubai, or something to the equivalent of a World's Fair that was supposed to last the entire year. So basically it would be like having the World Cup in your city like an entire year, or the Olympics, something like that. So they thought that it was going to be this huge boom to the economy. So let's just continue to overbuild the housing stock because we're gonna fill it. But then, sure enough, you get the cerveza sickness that comes in. So they got to lock everything down. No World's Fair in Dubai. Now you've got even more supply that's been driving the prices down since 2015, driving the prices down even further. I mean, it's just there is blood in the streets of Dubai.
Isn't that possible though? In like, for example, I even hear of, sometimes that makes me nervous about investing in other areas when it comes to real estate. But you even hear of people investing in real estate in smaller college towns where like the only thing attracting people to that city is one college. I mean, isn't that kind of like this Dubai example that you just talked about? Like, what if that college, because of COVID, goes bankrupt? And now all of a sudden you got yourself a ghost town. I mean, isn't that a realistic possibility in some of the areas that maybe we might not be like super familiar with?
Okay, I'm in Tucson right now. If your viewers don't know, that's the home of U of A, the University of Arizona. And I spent time in Tucson about 3 years ago. It was, it was booming. I mean, there were students everywhere. It was vibrant. You just go walking down the street and all the businesses are opening up, all the sports bars and restaurants and cafes and everything, the hustle and bustle. People are riding their bikes around, their scooters, their cars, it's all this right around the whole city really is kind of built around U of A and the downtown campus there. Fast forward to today. It's a ghost town.
Shut up.
Absolute ghost town. When I first got here, I stayed at this hotel that's right downtown. It's called the AC Marriott. It's one of the nicer hotels there, and I like it because it's proximity to all of the restaurants, bars, cafes, nightclubs. They're all a lot of cool stuff. It's got the theater there. You walked, it was like depressing. I mean, you'd walk down the streets and all the business, not all of them, but a lot of the businesses are boarded up, shut down. I mean, you go on corners of businesses and they'd have I remember this one business I saw had this big piece of plywood on the front of the door that said, Tucson, thanks for 40 years in business.
Oh,
and the whole town has just been gutted, just completely gutted. Now, once you get out into the sticks and out to the suburbs a little bit, it's not as bad because that economy didn't revolve around U of A. And, when I first got to checked into the hotel, I saw that it was just like nothing was open. It was like a Friday night, 8 o'clock, and there's nothing. There's no people walking down the street. There's a couple little things here and there that are open, but nothing like it was. So I went to the guy at the front desk of the hotel, and I said, "Is this just because of spring break, or I mean, what's going on here?"
Like where is everyone? Yeah.
Like, no, it's not because of spring break. It's like, this is what he goes. We just haven't recovered from the lockdowns and everything else. And right now, 50 or 60% of the students are taking classes online. They're not here anymore. And boy, I tell you what, if you would have invested in like student housing, which was supposed to be like the safest investment of all time.
Yeah. Yeah.
I mean, you know that from being in the real estate world. That's supposed to be the safest of all safe real estate investments. If you would have done that here, you'd be in a world of hurt right now.
Wow. So okay. So any pointers for people on if they want to get into real estate, like specific anchors that you think are more insulated anywhere around the world?
Around the world?
Well, I mean, like, because you had mentioned Colombia, but they could probably apply to, like, for example, I only invest in SoCal. That's because that's just my area of expertise. That's just what I know.
Right.
Look, I was born in Germany. I don't know how to invest in real estate in Germany. But yeah, so like I mean, the principles will probably work similarly, but I can't tell you which neighborhood's better and why a certain neighborhood is popping and why another one's not, you know?
Yeah, you got to be a local expert, to your point. And that's why I was saying about Dubai. I might be bullish on Dubai, but there is no way I would buy there right now, regardless of the price, because I haven't done the boots on the ground research. I need to go there for at least 3 or 4 months, at least, and just figure everything out, talk to agents, look at properties, figure out what's going on, just talk to taxi drivers, Uber drivers, people at the restaurant, the gym, just do whatever type of research you can do to just get a vibe as to what's going on, what's happening with prices, what's cheap, what's not cheap, is it under the cost of construction, what are the real RV ratios, what's the liquidity like, what's the debt options. You got to do all that stuff. If you don't, and I see people do this down in Medellin all the time, you got the gringos that come down and they find a website that's in English that's got a few listings, and they're like, oh, this is perfect, this is just like what I do at home, like the MLS, and they'll buy something and they'll pay triple what the going rate is just because it's in English and not in Spanish, because they didn't go down there for 2 or 3 months and do the homework. And if you don't do that, I would never suggest investing in real estate outside of the United States, unless you had some, like if you came to me and said, hey, George, could I use your team there, your general contractor, and could I have them find the wedge deal for me and just pay them a fee? I'd be sure. Yeah, let me give you their number, because they've worked for me for the last 6 years, and they could find you a wedge deal just as easily as they find me a wedge deal. But if you don't have that type of network or that type of connection set up, if you're just doing this all on your own, you're gonna get smoked big time. But what I look for is inefficiencies in the market, but I also look for markets that have very little debt in the system. Now that's a double-edged sword. It's bad in the sense that you're not going to be able to sell your property as quickly as you otherwise would. Like in the United States, if you got the right place at the right location, right price, boom. I mean, it's on the market one day and you're probably getting multiple bids or multiple offers. But in Colombia, it's not like that, because maybe I was reading a statistic the other day that said only 7 to 10% of people that buy in Colombia buy with a mortgage. Like they don't, they just use cash. So therefore, it takes you longer to find a buyer. Now, if you got the right property at the right price, obviously that could go from a year to 8 months or something like that. You could sell it in a month, who knows? But I'm just saying, on average, if you're trying to figure it out, it's going to take you about a year. So that's the downside. But the upside is that there is no leverage in the system. Therefore, how can you have a housing crash if no one has to sell? Like if no one has a mortgage, no one has a payment, they don't have to sell. So how are you going to get a mortgage collapse, or how are you going to get a real estate collapse? It's much less likely. They're not going to have that boom bust cycle that we have in the United States, because there's no leverage, right? So it really kind of, in my opinion, it caps your downside, but it doesn't have the liquidity. So therefore, you have to be able to get an even bigger wedge deal to make up for the lack of liquidity. Because like you in California, you could probably turn your money over twice a year. I would guess probably once every 6 months, like buying the asset, doing the remodel, and doing the flip or selling. But you could probably do that in 6 months. So you can turn that same $1 million over, let's say twice per year. Therefore, if you get a 20% return annualized, you've got a 40% return. See, where I can only do it once per year. Therefore, I've got to make sure that I'm getting on just one deal, I'm getting a 50 or 60% return, as opposed to that 25 or 30%, because I can't turn it over as fast.
Are you flipping them, or is it buy and hold?
Both.
Both. Okay. Yeah. I mean, but is that also why you see people come from South America to Miami and just pay cash, or are they trying to flee the government and park money in the United States, or what's going on there?
Yeah, I mean, they want some diversification. I mean, I definitely don't have all my assets in pesos. I can tell you that for sure.
Okay.
The Colombian peso is the local currency. But if you're someone that's in Argentina, what do you do with your money? You want to get it out of Argentina as fast as you possibly can. And you either want to get into local real estate, or you want to get into real estate somewhere, because that currency is just being inflated away. Not to the extent of Venezuela, but it's losing a lot of purchasing power. And let's say that you've got your guy you got $50 million or whatever, and you've got $25 million worth of real estate in Argentina. Okay, but that's still under one political jurisdiction. You're probably like, it's smart to have a little diversity here. And why don't we just go to Miami and buy at least $10 million worth of real estate, cash flow it, and I've got some dollar denominated income coming in, and I've diversified not only my currency risk, but I've also diversified my political risk. So I think that's why you get a lot of flows coming in from South America.
Wow, that's incredible. I mean, this is this has been an amazing discussion. All from you deciding to sue the Fed.
Yeah.
What have we not covered here? Have we missed anything? I mean, this has been so fascinating on inflation, on real estate, on your favorite types of investments, on government intervention and regulation and deflation. I mean, this has been incredible.
Yeah, no, we've hit a lot. This has been a lot of fun, and I don't know, maybe we can see what the most common questions are, and a month or so, maybe we can come back and answer those questions or do something like that.
I like that. I like that a lot. Golly, well, geez, in that case, how can people follow you? How do people reach out to you and follow you? Because you've got some really incredible and also unique perspectives. And I don't want to say so unique. Like, I don't want to say your ideas are outlandish. I don't mean to say that at all. Just different from what we hear in the mainstream. And I think it's excellent. I think it's wonderful. How can people follow you?
They can just Google my name, or my YouTube channel is George Gammon, last name Gammon. But if you just Google that, my YouTube channel will come up, my Twitter feed, my Instagram, my website, just everything I do. And if you want to find out more about suing the Fed, you know what's interesting on that, Kevin, is the first round we needed to come up with $100,000 for the FOIA part of what we're talking about, right? So what I did is I said, I'll put up the first 25,000, and then we'll set up a GoFundMe campaign to do the rest. But I said, for every dollar that's donated, I will donate the same dollar. I'll match it above and beyond the 25,000. So what that means is I'll put in 62.5, and then the people who donate put in 37.5 to get up to the $100,000. And you know what? We hit our goal in under 36 hours.
What? That many people are supporting this? That's incredible.
Yeah. Yeah.
That
Under
is, I mean, there are a
36
lot of
hours.
people are throwing their money at getting this information at the Fed. Like, I love the idea of it, but I'm surprised people $62,000. That's a lot, is what you are at now.
Well,
I gotta pull that up.
yeah, I put in 62. We stopped it right at 62.5 because I put in the first 25,000, and then it got up to 62.5 so quickly. I had to have my assistant pause it, and there for me to put in the dollar to dollar match that'll take us up to 100,000. You see that right there?
Oh yeah. So as soon as you hit this, you guys essentially stopped it. So now you've got the 100K. That's incredible. I'm actually happy to see that society is so supportive. Look at this. We did it with your help. Oh my gosh, you're right. This was March 31st. We hit our initial goal of 100K in less than 36 hours. Total donations are at 62.5. That's incredible. So there's the 100K because of your match. That's amazing. Congratulations, man. I'm so happy to see 3 days ago. Yeah. So happy to see that people are supporting you in this cause. So you're done. You don't need to raise money right now.
Yeah. Well, the lawyers, they always tell us it's going to cost 100 grand. And then you always got to add, 20, 25%. So we'll see what happens when Robert gets done. But just the FOIA part of this will probably take a year. So we're not going to know how it really pans out or what response we're getting for 6, 9 months, a year, something like that. So we'll just have to kind of play it by ear. But the good news is we're already getting the message out. We're starting to wake people up to the damage that has been done by the Fed. And whether it's been done intentionally or not, who knows? But the bottom line is they definitely intentionally went around the Federal Reserve Act. But we're waking people up to that. But I think even more importantly, we're waking up people to how damaging inflation is and how that really hurts the middle class. It hurts the poor. And if we want to be on more stable ground in the future, we've got to have sound money. And we cannot give the ability to just create more currency units on a whim to the central planners in the government and the Federal Reserve, because we'll have to pay the price of unintended consequences over the long term. So if we're waking more people up to that, I mean, it's already a win. It's been a huge buzz on social media, on Twitter. I mean, I only talked about it like once or twice on my YouTube channel, and I didn't have time to talk about it more. I was going to promote it. I was going to do all these things. And now, like, well, I don't know what I do now. We hit our goal so fast.
Next time you won't have to match.
Yeah. I had a lot of macro guys and gals too that are very famous. I won't mention their names, but when I told them about the project, they're like, "Yeah, I'll write the first check. I'll write the first check." And now they don't, they're not going to have the opportunity to donate. But if people want to find out more about kind of the details of what we're doing, we did a couple videos. They can just go to georgegammon.com/end-the-Fed. And that's a page that kind of outlines everything.
Final thought. Is the market going to crash big time in the next year?
Well, there are no certainties, only probabilities. I would say just slightly. I would say the probability is higher that it does not, because of the ease at which the central planners can now manipulate the market with additional money printing, just spending money, buying stocks. Who knows what on earth they'll do to backstop it next. I wouldn't put anything past them. And I don't think we've seen the extent to the distortions that they are going to create over the long term. Now, that said, I'm not saying that the market can't go down by 10 or 15% or 20%, something like that. I definitely think we could have a bear market, technically. But I think that they'll come in if that happens too quickly, and they'll take action that could bring it the other way. That said, I want to be very clear that in the absence of intervention by the Fed or the government, the economy and the market itself would want to deflate. There is so much debt in the system that it cannot service the debt with the cash flows. The stock market and the housing market for that matter would really, there would be a lot of deflationary pressure, meaning nominal prices would go down. Most likely. There'd be a lot of headwind there for prices. But you've got to counterbalance that now with all of this intervention. I think maybe a better question, or a more interesting question, is if you're looking at 1 year, 2 year, 3 years, is the market higher or the same in nominal terms, or is it or real terms? Going back to what we were talking about, see, the market can go up 5% per year, and everyone says, oh my gosh, well, this is great, the market's still going up at 5% per year, no harm, no foul. But if the prices of the stuff that you, the person watching right now, is buying every day, if those prices are going up by 20%, then it doesn't matter if the stock market's going up. You're still losing purchasing power by being invested in that S&P fund. So with as much money as they're creating right now, and with as much deflationary pressure as we have, it's really tough to figure out what prices are going to be in nominal terms and in real terms.
Yeah. Jeez, such a good point. Well, do you recommend people listen to what Ray Dalio says with a great deleveraging coming?
Yeah, well, I definitely listen to Dalio. I think he's got a lot of good things to say, but I wouldn't just listen to him only. I think there are a lot of great people out there that are in his league as far as their ability to think and understand the economy, that I would listen to try to get all angles. You know, one thing that I try to encourage people to do on my YouTube channel is to really get outside of the echo chamber that social media creates for us. You know, if you're on Facebook, if you're on Twitter, whatever, it's suggesting things to you that it thinks you are going to respond to favorably. Yeah. So if you're a Democrat, it's going to send you more Democrat stuff. If it's a Republican, it's going to send you more Republican stuff. And the next thing you know, every single thing in your feed that you see day to day to day to day is only one side of the coin. And I'm not talking about just politics. I'm talking about it's Keynesian economics and Austrian economics, whatever, free market, socialism, whatever it is, any of these debates that we have. If you only see one side of the coin, I think you're robbing yourself. In order to be truly intellectually honest, I think we need to try to get out of that echo chamber from time to time, just to try to poke holes in our own theory. As an example, I do the Rebel Capitalist show on my YouTube channel along with whiteboard videos. And as you can imagine, a lot of the guys and gals I talk to are kind of Austrian, free market, maybe lean a little libertarian, stuff like that. They're into Bitcoin, gold, things like that. But I've also interviewed Professor Richard Wolff, who's a communist, a Marxist, I think he would call himself. I interview people like a good buddy of mine, Professor Steve Keen, who is, I don't know how he categorize himself economically. I like to call him the rebel economist, and I'm the rebel capitalist. We kind of go back and forth with that joke. But he is by no means an Austrian at all. He believes that there should be a significant amount of government intervention in the economy and with the banking system. But I still love talking to him. I love talking to him just as much as I love talking to Peter Schiff, as an example, because it just gives me another perspective and makes me really think about my own belief system. And it strengthens my ability to think about things critically. Yeah,
absolutely. Wow, absolutely incredible. Well, George, thank you so much for your time. Everyone, George Gammon on YouTube. Take a peek. It looks like I just actually pulled up. It looks like you've had Peter Schiff on many times on your channel, actually. What, 2, 3, 4, 5 times or something like that?
Yeah, and I'm actually gonna fly to Puerto Rico on Tuesday because I keep my residency there, and I haven't told anyone, but we might do something live. We maybe because Peter lives down in Puerto Rico.
Yeah. So oh wow, absolutely brilliant. Well,
yeah, we might do something. Oh, and by the way, something you need to do is you need to do a live conference. I've been telling you about this for quite a while, and I just last month I set up a live conference in Miami, June 11th to the 13th. We're calling it Rebel Capitalist Live, where I've got all these people that I interview I'm bringing them to Miami to do a 3-day investment conference. And you need to do the same thing, my friend. We can talk about that offline.
Thank you so much. Awesome. Awesome. Well, thanks again. Thank you for everyone watching. If you found this helpful, consider sharing the video. Thank you so much for watching. Consider subscribing. Go check out George Gammon on YouTube, and we will see you in the next one. George, stand by for a sec.
Bye, guys.